have a government here that lacks economic policy credibility since the Brexit vote. Markets don't like Brexit.
It's quite clear the Bank of England do need to step up. Now, what will stop the problem is not the Bank of England.
The moves are extreme, but they are explainable.
The market's marking up what the BOE is doing.
The UK economy is heading into, if not already in, a recession at this point of time.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Turnaround Tuesday, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures up 0.7 on the S&P, on the Nasdaq up 0.9%. TK, the close yesterday, a new low for 2022.
Yeah, really ugly close. And, as you say, Turnaround Tuesday, John, that does capture it. By no means does it say all clear. I thought Kitchukes has really been following this nicely, combining different asset classes and different climate ideas here. And Kitchukes has more to follow. We heard that from I heard Jeff Yu with Nathan Hager on Bloomberg Radio. Same thing. More to follow.
Have you seen the range on sterling, Tom, in the last couple of days? The range yesterday on cable, the low 103.50, the high 109.31. That's quite an intraday range on a G10 currency.
Yeah, I'd never want to slow the show down with math, but guess what, folks? The pros now are really looking at this volatility. One idea to look at, John, is the real yield. You're familiar with that. This is what all the adults follow, the inflation-adjusted yield, and it's real simple. John, this is stunning, 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 stunning. We are 83% back from that negative 1.11 to the average before the great financial crisis of 2.05%. Most of that's been done in the last 3 cups of coffee with Marmite.
A huge turnaround, Tom, without the Marmite. I don't think we need that. The last couple of days, the front end of the yield curve in the UK. What are we up, Lisa? 100 basis points or something close to that in the previous 2 days?
It's been like, 50 basis points every day. And Deutsche Bank did a study showing that the 5-day rolling increase that you've seen in 5-year gilt yields has been the most on record going back to 1979. The reason why today's reset, today's pause is interesting is because you're seeing a buying of the dip not only in stocks and the risk assets, but in bonds, and it feels stickier, John. And we're hearing from more investors that it starts to look attractive with real yields where they are. Goldman Sachs tried to coin the phrase Terra.
I saw that.
There is a reasonable alternative, which I don't know if it's going to stick.
And it's in the bond market. It's not in equities.
Exactly.
When you say people are getting more constructive, I know where you're going with this. It's in the bond market. It's not in stocks.
But that's exactly right. So this is the first step in finding a bottom, right? It's basically people saying, okay, maybe we can go into these yields here. However, yesterday's 2-year auction was actually really messy. So there is still some question about who's going to come in.
Why was it messy?
I
don't understand.
There wasn't as much demand relative to what they were offering as people had expected. So in other words, what dealers had to take down was bigger. The individual investors were not taking down as big of a share. So that raised some concerns and actually spurred a bit a higher leg upward of the yields yesterday.
We're going to spend the morning talking about Tara.
Tara.
Is that going to catch on?
No.
I think I need to wear my Tara.
Not.
No?
No.
You're not having it, Tom?
John, it's historic times. I really want to emphasize this is a global condition. We're not just focused on sterling, although that's where the focus. Yeah, that's where it is. But guess what? There's other currencies. EM DXY today move on a percentage basis, very much the same. EM is not giving it up.
Tara. I'm going to talk about that a lot today.
Frankly, I don't give a damn.
Just to wind him up.
Tara Tuesday.
Futures up 0.8 of 1% on the S&P. On the Nasdaq,
Can I say that
up by 1 full percentage point. You just did.
Okay.
Yields down 8 or 9 basis points, 383.75 on a 10-year. It's basically the last couple of days upside down. Euro dollar just about holding on to 96.11, and crude, Lisa, 77.55 on WTI.
Yeah, upside down, but not necessarily with the same magnitude or conviction. Perhaps we'll get some conviction with some Fed speak. A lot of it. We get another scroll of Fed speakers today, including Chicago Fed President Charlie Evans, Fed Chair Jay Powell in a Bank of France conversation with ECB's Christine Lagarde and BIS head Augustin Carstens, and then, of course, Jim Bullard of the St. Louis Fed, and Minneapolis Fed President Neil Kashkari, San Francisco Fed President Mary Daly. What are they all going to say that's going to change the perception? We did hear a host of Fed speak yesterday. Conclusion still the same. They see health in the market, strength, the resilience, and the balance sheets of consumers, leading them to want to hike. John, you were talking about this. Hugh Pill, the chief economist from the Bank of England, is going to be speaking around 9:30 a.m. Eastern time today. That may be the most interesting based on what we heard yesterday from the Bank of England. And then the response, where you saw a renewed leg downward in the pound as they realized that the Bank of England was not going to act in an emergency kind of measure just yesterday. Today, we get a host of U.S. data, including U.S. FHFA house price and S&P CoreLogic house price data at 9, and then some home sales data at 10 a.m. Housing prices, how much are they declining given the lack of volume, given some of the concerns about mortgage prices, and given just this feeling that perhaps people are not as willing to pay these prices? And at 1 p.m., the auctions actually matter. And U.S. is planning to sell $44 billion of 5-year notes. I didn't mention yesterday's auctions, and I regret it, because yesterday's 2-year auction was actually important and market moving. How much demand is there for 5-year yields near the highest levels going back to the last financial crisis at a time when people really don't know how much further they could go, John?
I find those charts just to be absolutely amazing.
They're on radio, they're particularly good.
Through the valley of the pandemic, Lisa, and out the other side, almost vertically.
Yeah, through the valley of the shadow of pandemic, you know, we can talk about poems, but I do wonder if we're looking at something that is a 5-year treasury yield or Bitcoin, and people have talked about that. What does it mean when full faith and credit is moving like a penny stock?
Bramo, thank you. Looking forward to the auctions a little bit later. Alcelinos is too, Global Head of FX Strategy at RBC. Alsa, good to catch up. We're going to hear from the Chief Economist, Hugh Pill, of the Bank of England. I can't believe Lisa's got us involved in BOE speak and not just Fed speak now. What do you want to hear from the Chief Economist on Threadneedle Street?
They are in a very tough spot, as everyone says. They're damned if they do and damned if they don't. If they look at the outlook for them at the moment, you've got rates pricing in kind of next year, households that are already going to be facing higher mortgage bills, higher energy bills, and then higher mortgage bills potentially when they reset their mortgages in 2023. So I think it's a very tricky situation for the Bank of England to find itself in. Right. I am sure they're not going to be rushing to hike rates as fast as everybody wanted them to, in part because it's not clear what the best path is.
Elsa, Hugh Pill is as American as you can get in academic economics. Oxford PPE and his Stanford degree speaks volumes about looking at the market. Does he represent the theory of the Bank of England right now, or is their theory make it up as they go?
I don't know that it's making it up as they go along, but they are in an unprecedented situation with regards to your kind of regular G10 central bank policy making.
But Elsa, I want to interrupt. This is so important. Ronald Reagan had Paul Volcker to raise hell. Does Andrew Bailey have the ability to straighten out the children? It's as simple as that.
They are so careful at this stage because of everything that's come before. We had a summer of Liz Truss campaigning, saying, amongst other things, we should relook at the independence of the Bank of England. And I think the last thing the bank wants at the moment is to become a political tool or get caught up in a political fight. So it really speaks more towards waiting, letting the market force them rather than being proactively.
Also, you were talking about a lower range for the pound versus the dollar. How low can it go before there is some sort of response politically, if not from a monetary standpoint?
So big psychological levels like parity always stick out in people's minds. Of course, a lot of what we've seen in the last week has been dollar strength as well as sterling weakness. Actually, if you look at euro sterling, it's not moved quite as much. And in trade weighted terms, the pound is down about 5% year to date. So I don't think that from an economic perspective, we've really seen the pound materially cheapening up. And in fact, that's what we were looking at this morning. If the pound is not, then it's very hard to say this has run its course and can go no further.
Do you think that the Bank of England needs to validate current market pricing, Elsa? Because market pricing has adjusted in a humongous way in the last week or so.
It has, absolutely. But at the same time, it's a reaction to both what's going on domestically, but also global bond pressures. You know, Lisa was talking about the 2-year auction yesterday in the US. We've seen similar kind of movement across the world. So this isn't something completely unique to the UK. And the Bank of England is not there to step against or kind of stand in the way of it. You know, if the UK government is announcing unfunded fiscal expansion, then markets react as they have done. And hey.
Elsa, wonderful to catch up with you in London, as always. Asselinios there of RBC on some wild moves in UK markets over the last couple of days. I found the Bank of England statement to be pretty interesting, to be honest with you, and only one part of it was interesting to me. It was the second paragraph. The second paragraph where they acknowledged what the government was done and at times said they welcomed it. Tom, they said, I welcome the government's commitment to sustainable economic growth and to the role of the Office of Budget Responsibility in its assessment for prospects for the economy and public finances. Just a peculiar effort not to go against the government too much in this. It was an interesting one from Governor Bailey yesterday.
Yeah, I'll go. What matters is a bar chart. I've seen it from Bloomberg, which is really good. I've seen it in other media as well. And this says only one precedent back to, I think it was Balmer in the 70s. I can't remember the exact date right now, John. But they're reacting to unprecedented action. Everybody, whatever their politics, can agree on that, or their economics. John, to give an idea of how extraordinary we are living right now, the Bloomberg Financial Conditions Index for the United Kingdom is very, very good math. It's a set of ratios that sum together the dynamics of any given nation. The number to focus on is the accommodation forced by the Chancellor was 5.2 standard deviations. We've come in this morning to a still lofty, unstable 3.4 standard deviations of accommodation. That's what the governor has to deal with. That's what Hugh Pill has to deal with this morning.
Looking forward to hearing from Hugh Pill a little bit later alongside all of that Fed speak. Chairman Powell later too, Lisa. Just to clarify, that's on digital currencies and not on the economy.
Right.
Not on Fed policy and monetary policy.
Can I ask you, who's not speaking? Is there anyone not speaking today?
There's a few people not speaking. I would like to hear Chairman Powell talk about monetary policy maybe another time.
I don't think that he's going to be able to avoid it completely with Christine Lagarde there, too. I mean,
Maybe.
How can he not talk about the dollar?
They like discussing digital currencies and stuff like that.
I know, but how can they then not talk about the strength of the dollar? How can they not talk about the currency turmoil right now? Rather than say, theoretically in 25 years.
Are they going to be on the crypto show this afternoon? Powell,
hosted by Bramo.
Guys, what are you doing?
Lisa's very fired up about this. Can they talk about where the dollar's going to be in 25 years? They could have a really long time horizon. Super long.
Just say it's going to be digital. Why do we care?
It's going to be super digital.
My brain is going digital.
It's going to be fine. Futures, positive 0.8%. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian is threatening to become the worst storm to hit Tampa in more than a century. Ian has picked up strength and is now a powerful Category 3 storm. It made landfall in Cuba early today. Ian could reach Florida as early as Wednesday with top winds of 140 miles per hour. More than 300,000 people are expected to evacuate. The British pound is higher today after hitting a record low on Monday. Still, traders remained wary of the chance that sterling could fall to parity with the dollar. The Bank of England indicated it may not act before November to stem a rout in the currency. It's the clearest signal yet that natural gas flows from Russia to Germany over Nord Stream won't resume this winter. The pipeline's operator says that it has sustained unprecedented damage. Leaks have been detected, and markets will be watching for any indication of sabotage. At least one major investor thinks the worst global bond rout in decades is creating a buying opportunity. The co-founder of Double Line Capital, Jeffrey Gundlach, tweeted that he has been a buyer of treasuries recently. It's a potentially bold call. The Fed has delivered the steepest interest rate hikes in a generation and is pledging to keep rates higher. That's proved a toxic combination for treasuries. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Returning inflation to our 2% target will require further tightening of monetary policy, as signaled in the recent FOMC projections. It will be important to see clear and convincing signs that inflation is falling.
Rinse and repeat. Susan Collins, Federal Reserve Bank of Boston president there, live from New York. Good morning to you. Futures up by 0.9% on the S&P. On the Nasdaq 100 up by a little more than 1 full percentage point. Yields back down, lower, negative by about 10 basis points on a 10-year, 382.13. we came very, very close to looking at 4% on a US 10-year. It is a turnaround this morning. Let's see if it sticks. The euro just about showing some strength here. Euro dollar positive, 0.1% on that currency pair, Tom, at 96.21.
Right now, what we're going to do, and this is a joy in this midterm election as we begin to look towards our coverage in Washington, all that we're going to do with Anne-Marie Horton. It is good to speak to someone with decades of experience who has an exceptional ability to go topic by topic. That's James Lucier, senior political analyst at Capital Alpha Partners, iconic at Prudential over the years. James, thrilled to catch up with you at this moment as well. I want to look at, there's a shutdown and there's not going to be a shutdown and everything else every other network's talking about. But I want to know what the senator from West Virginia does. If the Republicans take the majority, does he switch over to the Republican Party?
Well, Tom, Chris Whalen sends his greetings from dinner last night. There is not the most remote possibility of a shutdown at this point. I think that Manchin is already telegraphing his pathway to a graceful retreat. He does not have the votes to pass his permitting bill, so he'll simply vote for the continuing resolution when Schumer brings it up a second time, either tonight or more likely tomorrow.
But what's so important here, James, is the guy is so powerful in a 50-50-ish Senate. Is it imaginable that on the first Wednesday of November, he becomes a Republican to give them the majority?
No, it's not remotely likely that he becomes a Republican because he is a truly committed Democrat. He is an LBJ, Great Society Democrat. He remembers the Kennedy Democrats who ran the Appalachian Regional Commission and brought so much money. He's a traditional Bobby Byrd Democrat in many ways. He's just not necessarily a new wave progressive Democrat. He is not one of these conservative Democrats from Texas who are really little Ted Cruz's in the making. He's a dyed-in-the-wool Democrat and will not switch. Now, his problem, though, is that he has gone from an almost unchallenged electoral position in West Virginia to one where he is currently polling behind Alex Mooney, a congressman. So he does not have a path to re-election. I think he does not have a path to become the John Breaux of the Senate, where he is the deal maker and everything. He's really, I think, destroyed his relationships with both sides at this point. He's the 50th vote, but doesn't have a lot of that swing voting credibility.
Let's talk about the path for President Biden heading toward this midterm election. We have seen gasoline prices bottom out, start to tick higher. And yesterday we get this, President Biden coming out and saying, all of those big oil companies are making too much money. They need to cut their profits. They need to continue to lower prices. How much is that really going to play well heading into the midterms as gasoline prices aren't necessarily at the forefront in the same kind of way?
Well, you've got the bigger problem of economic chaos in the global markets showing up in terms of consumer confidence, consumer perceptions of the state of the economy, the idea of the Fed clamping down, the fear of a recession, not now, but next year. All of this undermines the sunny economic message, which was really powering Biden forward from early August on. I mean, Biden really had a great month of August, and he's had a great September. But I fear that his timing was a little too early, and this combination of economic worry, oil prices that are down now, largely because of Fed action, largely because of the fear of the recession. You still have people facing significant problems in their cost of living, and they are constituencies also that are very important to the Democrats, like the working class Hispanics in Nevada. So. I think that.
Well, this is really important, especially given the fact that President Biden's spokesperson yesterday came out and said that they're closely monitoring some of the market volatility, to your point, that was spurred or has been spurred from some of the Fed speak. Do you expect a more aggressive Elizabeth Warren type line from President Biden with respect to questioning this Federal Reserve and its actions heading into the midterms?
Well, I'm not sure that the White House can challenge the Fed going into the midterms now. It would really show that they're worried about the economy. But the real worry the Biden crew has to have is that we are in a recession in the event that Biden does not win a solid Senate majority and at least keep things close in the House. I think the Senate could go either way. I do think the Democrats have a chance of getting a House majority. If Democrats do well in this election, Biden's in a much better position than he would be if you have a recession imminent and Republicans controlling both chambers. We don't need to worry about a government shutdown now, but in future years, as the U.S. deficit increases and Biden is going into his re-election cycle, I think next year is the time you worry about shutdowns.
It's a big change from where we were just 6 months ago, maybe even 3 months ago. James, fantastic to catch up with you, sir. James Lucia there of Capital Alpha Partners. Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully? What on earth does that mean?
They pull up the NASDAQ, they pull up the S&P.
Never understood.
It's down.
Excuse me, guys.
That's what that means.
Guys, it means they have a Bloomberg. Okay.
I've seen the Bloomberg.
They have
White House, Tom.
They have
I've been in and seen it.
Lots of Bloombergs.
Okay. There is this point, though, underpinning what you're saying, which is there an action that comes along with watching, or is it, hey, we're seeing that too. We saw something too. It was down.
we watched it. It only means something if you have the power or the willingness to do something. So when the Bank of England says something like, yeah, we're watching it, you get the feeling it means like we might do something about it. When the White House says we're watching it, I just don't even know what that means.
Although even the Bank of England, basically people questioned what that meant as well. And they said, well, if you're going to act, why aren't you acting right now? Why are you just basically reaffirming that there might be some credence to this potential policy?
Well, they've at least got something
political
on the schedule to do something about it.
Correct.
I'm not sure whether the White House press secretary has got the same thing written in to maybe cut interest rates in the future at some point. Anyway, you've got to explain this one to me as well. We've all woken up to headlines about how damaged Nord Stream 1 is. And I have to say, Lisa, I'm sort of scrambling around trying to work out where the damage has come from. The EU Commission just said that they can't determine the cause of the Nord Stream leaks just yet. It's kind of bizarre this morning.
The whole thing is such a strange story. Reading it, you're like, are they telling us that one actor sabotaged this, or do they just not know that one actor sabotaged?
No idea. They're saying we would condemn any act of sabotage.
If it happened, theoretically.
Something's happened. Futures up 1% on the S&P. It's a bounce off the lows of yesterday, which at the close were the lows of 2022. From New York, this is Bloomberg. Bouncing back this Tuesday morning. Good morning. Here's the morning price action in the equity market. Futures up higher. Positive on the S&P by more than 1 full percentage point, and the Nasdaq up by 1.39. On the S&P 500, new closing lows yesterday for the year, the lowest since December 2020. We turn around just a little bit. Let's see if it sticks. And the bond market, similar story. Last couple of days, last couple of months, upside down. Yields lower by 9 or 10 basis points on a 2-year to 4.2438 after rising for 13 consecutive sessions.
Wow.
Bear in mind, to a 2007 high, just off a 2010 high on a US 10-year. We retraced some of yesterday's move. We're down 11 basis points, Tom, 381.53. Just want to finish on foreign exchange and have a little look at sterling, which is back to a 108 handle all over the place in the last 24 hours. A high of 109.31, a low of 103.50. Hard to keep up with this one, Tom. Front page of the newspaper today in the United Kingdom, Daily Star, kind of newspaper you might enjoy, Tom. Tabloid.
Page 3, right?
Honey, I Shrunk the Quids.
Yeah.
Honey, I Shrunk the Quids is the front
What's
page.
What's a quid? Is a quid a pound?
A quid is a pound.
Good. Did you like my banner yesterday on pennies and farthing? And
I can't say I did.
Oh, that was very Dickensian.
Is that what it was?
That was very good.
Not a currency I ever got my hands on, Tom.
Right now, we are going to stop worldwide and have a conversation with a definitive expert on EM, arguably with Stanley Fischer. He invented our concept of emerging markets. This is a guy where Damian Sassower of Bloomberg hangs on every word. Mark Mobius was a communications major who got parchment from MIT years ago and basically invented for Sir John Templeton the emerging market business. We're honored that Mark Mobius joins us from Dubai this morning. Mark, just what a pleasure to have you with it. Let me cut to the chase that every pro wants to know. How close are we to the instabilities of 1998? Or 1992?
I think we're very close, actually. We're in really a strange situation because on the one hand, you've seen this incredible increase in money supply. And my definition of inflation is devaluation of currency. And if you increase money supply by 40%, as we've seen in the US, then that's what the devaluation of the money is going to be. And of course, that's where prices are going to go. But we're in a very strange situation now because we've got these cryptocurrencies. And here in Dubai, notice that there's so many people transferring money in cryptocurrencies. And if you look at the emerging markets in particular, places like Nigeria, they do a tremendous amount of turnover in cryptocurrencies.
Mark,
What is money supply? That's a big question mark.
Right. I look, Mark, and you and I were on a stage at the Waldorf Astoria, I'm going to say 8 years ago, and you stuck your neck out and said, baloney, that the rules have changed for EM. There's this this conceit right now that EM is more financially solid. EM has their act together, unlike 1998. Do they?
It depends on the country. That's the great thing about emerging markets. You see such variety. You see some countries that are doing a terrific job. By the way, Brazil, which used to be a basket case, has been doing a pretty good job in stabilizing the economy. And then you go to a place like Taiwan, even Indonesia, they've been doing a very good job in managing their economies. So it really depends on where you're going. And then you go to Turkey, and then you have tremendous amount of devaluation of the Turkish lira and really a lot of instability financially. But there are even opportunities in Turkey.
So, Mark, at this point, you started by saying that there are some analogs to 1998, that we're getting close to that. What's the dividing line between now and then, the trigger point that makes this devolve into something that needs to be immediately addressed, rather than just a rapidly evolving ball of pain for debt investors?
The real situation now is that, unlike what we had in the past during the Asian financial crisis, is that the dollar debts are not as big as they were, because a lot of these countries learned their lesson. It was not a good idea for them to get into dollar debt, so they realized that and didn't do it, except for a number of countries that have been involved in the Belt and Road projects that China has been doing, where they've lent an awful lot of money in renminbi and dollars to these countries, which they can't pay. So here again, you have tremendous differences between countries. And in some cases, as I say, we're closer to these Asian financial crisis kinds of situations.
Mark, I'm glad that you brought that up, the Belt and Road Initiative of China, which by some accounts has significantly soured. There was one report recently, it was published in the Wall Street Journal yesterday, that nearly 60% of China's overseas loans are now held by countries considered to be in financial distress, up from 5% back in 2010. This really raises a concern for China, which has acted more like a banker than, say, the IMF when it comes to these types of loans. How does this develop, Mark? How does this evolve into something that could potentially have contagion effects in markets? Are there countries that are going to just basically be flat on their backs, unable to pay their bills that you're looking at?
There are a number of countries in that situation. I was in Sri Lanka 6 months ago, and of course, they're flat on their backs. They can't pay, and they owe the Chinese so much, and of course, they owe other donors. The problem is that nobody knows what the numbers really are, because the Chinese signed agreements with these countries that they should not disclose. They cannot disclose what they owe and what the Chinese lent to them. So we're really in a dark spot. And if you talk to IMF people, they're really very unhappy about the situation.
Mark, I've got a fancy chart, really fancy chart, that's a very weak extrapolation of how we get to another Plaza Accord. And the naive chart is 2032. I don't buy it for a minute with the rates of change, first and second derivative dynamics that we see right now. How close are you and I to having a beverage of our choice at the Plaza Hotel?
Yeah, this is a really interesting question, because here you have the dollar so strong, okay? And prices in America are not down. In fact, I just took a 1 month trip all over America, and people are spending like crazy. Then you go to London. Now, the pound has devalued against the dollar by what, 30%? And yet, try to find a hotel, a decent hotel in London, below 300 or 400 euros or 400 pounds. It's crazy, the whole situation. And that's why I say I think we're in a situation where nobody really knows what the money supply is. And I believe a lot of this is because of the crypto world.
Mark, you've got standards. I'm guessing you're looking for a different kind of quality hotel compared to many of us. I mean, you can't do five-star London for like £300 anymore, Mark. Times have changed. It's not just inflation.
I usually stay at the chain hotels. And by the way, in the U.S., I checked into a Marriott, and the front desk asked me when I was checking in, "Do you want maid service?" I said, what do you mean? I said, we don't give maid service unless you ask for it, and it's only every 7 days.
Only every 7 days.
That's like Pharaoh's house.
Yeah, I'm not sure that would work for me, Mark. Mark, I wanted to bring up Raphael Bostic of the Atlanta Fed on the UK. And Lisa, I want your view on this. He was basically asked about what was happening in the UK at the moment and whether it adds to the odds of a global recession. And he turned around and said it doesn't help. And I just wondered what the rest of the world would like to say back to the Federal Reserve, Lisa. If people are worried about the UK not helping, I mean, surely the Federal Reserve and aggressive rate hikes and a strong dollar is a bigger threat to the global economy than what is going on in the UK.
Well, and that's actually perfect segue, Mark, into what you're looking for in terms of some of the distress that you're focused on for some sort of response from the Federal Reserve, some sort of concerted effort like Tom was talking about. Basically, is there a cap on how much pain there can possibly be? Is there a trade that you're looking at?
I don't think the Fed is going to care about the markets. They're going to care about inflation. That's their first priority. And their playbook is to keep on raising rates until the rate is above inflation, which means you're talking about 9%. Inflation is now 8%. Now, if you look at the UK, to be fair, they have been reducing money supply. Of course, they raised it as much as the US, but the US money supply is still up there. It's not really going down that much. So I think we're in a situation where the playbook for the Fed is going to continue, means they're going to continue raising rates. And the market is just going to have to live through it. And by the way, let's be reminded, high rates don't mean a bear market. I mean, there have been many cases in history where the rates were high, but we had a good, a good bull market. So we have to watch that space carefully.
Mark Mobius, great to catch up. Going to catch up with you at short notice too. Mark Mobius, thank you, sir, of Mobius Capital Partners. I want to talk about this through this morning, about why a Fed pause and whether that's bullish or not should be questioned. And Tom, the issue I have with this whole Fed pause thing right now is the only thing worse than the Fed hiking in a recession is not cutting in a recession. If the Fed pauses, we have to ask ourselves what the economy looks like in that environment. And if we're in a recession and the Fed just stops hiking, as opposed to what it traditionally does, which is cut interest rates, I struggle to see how, Tom, with conviction, that would be bullish.
This is original territory led by a massive fiscal shock from a natural disaster. We're still dealing with it. And John, what you're going to see, and you heard it from the wonderful Charles Evans this morning, and I'm sure we'll hear it from others as well, is look for hedging October, hedging November. They're going to start hedging the words. The certitude of August is going to drift away.
What I heard from Charles Evans this morning, Lisa, was the hope that maybe unemployment only goes to 4.5% and that we don't get a recession. 4.5% is still a pretty decent move from where we are right now.
It still means hundreds of thousands of people losing their jobs,
Precisely.
Which is not a comfortable position for anyone to be in. The hope, I think, with the Fed pivot really comes down to that the economic data cooperates, that we actually get a massive deceleration in inflation from crossover effects or whatever the case may be, a normalization from that shock. Save for that, you're right. An actual retracement would have to come on the heels of significant pain that some people argue, Mike Wilson included, has not yet been priced in.
Drum roll. Marko Kolanovic of JP Morgan. Now, I'm not going to say he's
sort of
super bearish. It's a sort of drum roll. I'll give you the first paragraph and I'll save the second paragraph for later.
What is this,
You can't do
Just,
that.
it's a tease. That's what a tease is. It's TV, guys. Keep up. Here's the quote. Rising risk that the Fed engineers a recession by intent or accident. While we remain confident that a softening in labour markets and core inflation is in the pipeline, we're becoming less confident that central banks will pause. Find out if he's bearish next.
He's not.
He's not. Futures up 1% on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian has now turned into a powerful Category 3 storm as it takes aim at Florida. Ian made landfall in Cuba early today. It's now on track to become the worst storm to hit Tampa in more than a century. Hurricane conditions could arrive in Florida Wednesday morning with winds of up to 140 miles an hour. A meeting today between Chancellor of the Exchequer, Kwasi Kwarteng, and top British financiers could be difficult. Since Kwarteng introduced his mini budget on Friday, the pound has plunged and shares in British banks and insurers have been battered. Those attending the meeting will want answers on how Kwarteng can restore investor confidence. President Biden is repeating his demands for oil companies to charge less. At a meeting of the White House Competition Council, the president said that the price of oil worldwide was down last month, but, quote, we haven't seen the lower prices reflected at the pump. Gasoline prices in the U.S. have fallen by more than $1 since hitting a peak of more than $5 a gallon in June. Goldman Sachs and BlackRock are turning more bearish on equities for the short term. Both warn that markets are yet to price in the risk of a global recession. Goldman cut equities to underweight in its global allocation over the next 3 months. BlackRock is advising investors to shun most stocks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We expect to raise interest rates further over the next several meetings to dampen demand and guard against the risk of a persistent upward shift in inflation expectations. I cannot bring the price of gas down. I wish I could, but I can't. Maybe a good reform in the electricity price setting would help more. This is not for me to do. I wish I could.
It's a strong suggestion from Christine Lagarde, the ECB president from New York City. Good morning to you. Here's the equity market, a bounce back off the lows of the year on the S&P 500, positive by more than 1 full percentage point, up 41 points. I promised you the second part of JP Morgan's Marko Kolanovic. Here's the follow-up. Fed hawkishness leaves stocks very oversold. Some preconditions for a market bottom are falling into place. Stocks are looking increasingly cheap and approaching deep value outside of the US, and positioning is extremely depressed. Interesting, actually, in all seriousness, how the tone of some of these notes from the big bulls has changed, Tom. They're starting to talk more about limited downside than they are about this massive move up that they're expecting into year end.
What they're waiting for is October 14th when the earnings season clicks in.
Sure.
And as somebody said yesterday, I'm sorry, I can't recite it. It's not about this coming Q3 into Q4. It's about what happens early next year. And there's a fair amount of gloom out there about that. I'm going to keep my opinion out of it. Here's my opinion, though. Selected group, I'm going to remember Deutsche Bank Hydrocarbons and certainly Edward Morris at Citigroup absolutely nailed the 37% decline we've seen from the panic of 120 down to $80 on West Texas Intermediate. Is it the call of the year? No, I'm going to give that to Priya Misra, but it's right up there. Stephen Schork lives this, president of the Schork Group, and he is absolutely definitive on the micro data of your hydrocarbon market. Stephen Schork, Ed Moore says we're going to wander down to this range. What are the ramifications for your world if oil continues to drive lower?
Yeah, absolutely. We're still at a level, Tom, looking at oil in the mid to high 80s, which is still an attractive level for the producer and both the consumer. So it is the sweet spot where the prices are high enough to attract investment into bringing more BTUs to the market. And it's not so high that it's going to choke off demand on the consumer end. Our concern now is we're now testing an area mid to high 70s. This is the low end of the limit of our mild recession scenario. So we're down here. I've been in the camp for the past several months that the United States economy, global economy, are in recession. And we are seeing that pullback in most commodity markets, especially in the energy markets. Now, the concern here is if Jay Powell succeeds in what he's trying to do, and that is halt inflation, well, he can certainly send the United States economy into a tailspin. And of course, the global economy will follow.
Yeah, but what's the history? That's great, Steve. You went right where I want to go. What's the history of central bankers intruding into macro demand that affects the hydrocarbon market? I don't see a history where they're really worried about a gallon of gas.
No, they're not. They're worried about a gallon of gas, Tom, from the standpoint that it is a key driver in inflation. Now, I'm going to take a kind of a shot at Lagarde here in that previous clip and saying she wish she can control energy prices. Gee, does she wish she can control food prices? Because that's the other shoe that is going to drop on the economy's neck here. It's not energy. Gasoline prices have fallen for 90 consecutive days, a streak that just ended about a week ago at the retail pump. So we are seeing that pullback in energy. What we're not seeing and what we're going to see is we're not seeing any pullback in food costs. And because this harvest in the United States, it's going to be a poor harvest compounded by the lack of supply coming out of Ukraine. Food inflation is the next shoe that drops on this economy. Inflation is going to continue to run away. The Fed has no choice but to choke off this demand. And that therein is the risk, Tom, that if we do go in from a mild recession into a severe recession.
This is too gloomy. Lisa, pick it up and save me.
Oh,
This
yeah,
is just
I'm going to
too
make
much.
it super cheery. So
Yeah.
let's talk about this rolling inflation from one area to another. And this is one theory behind sticky inflation, that it has to happen where one area after another experiences a real pickup in pricing, so it really perpetuates itself. Does that leave some sort of scenario next year where you get some serious deceleration in inflation? Or does that mean that right now we're looking at rates that are going to have to stay high because inflation is going to be that much more persistent than people are really aware of?
Absolutely. I think on both sides of the aisle, they're playing whack-a-mole when it comes to inflation. They attacked one area, energy, over the summer, and they hit that mole down, and now that food mole has popped up. Now, the problem going forward is the United States now is committed to buying back all those barrels that we withdrew from the Strategic Petroleum Reserve.
Right.
Okay, that's great. Those barrels are at a 40-year low. But now U.S. producers have gone into a deal with the government that they're going to start supplying at attractive prices that oil back to the SPR. So when it's time for the government to start buying back the SPR, they're going to be competing against U.S. refiners because now U.S. producers are going to be selling to the government when they should be selling to the refiners. Inflation's here to stay. Higher rates are here to stay.
Stephen, when we take a look at the U.S., it pales in comparison to some of the energy problems in Europe, which is the reason why Christine Lagarde is hoping and wishing she had more control over that situation. Are we properly priced for a winter in which no gas goes through Nord Stream 1?
No, we're not. We've seen where we can go. A few weeks ago, natural gas prices in Europe went to nearly the equivalent of $600 a barrel oil. Now, Lagarde, they want to have the reforms. Let's talk about what the EU did 2 years ago when they cut off the supply of permits in the carbon market, which drove carbon prices 600% higher, which in turn drove natural gas prices 1,800% higher. And this all preceded whatever happened in the Ukraine. So we do have government manipulation in that market that did set the course for a runaway natural gas and hence electricity market in Europe. Now that's being compounded by the Ukraine. And what we're seeing now with both Nord Stream 1 and, of course, the headlines of Nord Stream 2 is no, we are not priced. It's going to be a very cold, chilly winter in Europe, and I do not think they're fully priced in for it.
Stephen Short, many people agree with you, sir. Stephen Short there of the Short Group. Gas prices up again today, Lisa, and the bearish case, the most bearish case you could make for Europe at the start of the year. I think a lot of people would argue that it's materialised in Europe. Nord Stream 1 can joke about the way this has been communicated today. It's down going into winter. Have they managed to get storage to where they'd like it to be ahead of time? Yes, we've seen a lot of headlines about that. But David Folkers-Landau of Deutsche Bank spoke to our team earlier this morning. And the point that he was making is an important one for all of us to realise. The prospect of gas rationing in Germany. What it means for industry, where we're already starting to see shutdowns, Lisa, because they can't afford to pay the bills. How much more of that are we going to see in the next 3 months?
How do you price in the ramifications of industrial stasis in the response to a lack of natural gas? It is hard to game out, but you're right. If it's the base case, do people start getting ahead of that? We've already seen that on the peripheries, the idea that we are seeing factories start to grind to a halt in certain peak hours.
John, I just did this for the first time in the holiday season as Elise Brown across Central Park. I looked at the low for Berlin this week, and it is a stunning 40 degrees Fahrenheit in 2 days.
We need a meteorologist, Tom, to talk about Europe. We really do.
We will need that.
Futures positive 1% from New York. This is Bloomberg.
We have a government here that lacks economic policy credibility since the Brexit vote. Markets don't like Brexit.
It's quite clear the Bank of England do need to step up. Now, what will stop the problem is not the Bank of England.
The moves are extreme, but they are explainable.
The market's marking up what the BOE is doing.
The UK economy is heading into, if not already in, a recession at this point of time.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
And breathe. Live from New York City. For our audience worldwide, good morning, good morning. This is Bloomberg Surveillance, live on TV and radio, alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures bouncing back by more than 1%. TKH yesterday, upside down.
A really historic day. Damien Sassar, who is absolutely brilliant at Bloomberg Intelligence Derivatives, just publishing on all this, John. And he really emphasizes the global nature of it. Yes, there's the idiosyncrasies of Istanbul, Ankara, of London, the city. I get that, John, but this is a global event we're seeing at all centers around. The Fed speak today, the Hugh Pill speak today, and what we'll hear from Jerome Powell in the coming days.
After quite a session yesterday, Tom, with the S&P 500 closing at new lows for the year, the lowest since December 2020, and the 10-year closing at the highest since 2010. It's been quite a story over the last couple of months.
You begin to think about a Dow, 36,000 to 26,000. Is that even feasible? And you know, I thought the Wall Street Journal really led on that well yesterday. The VIX is only 31. John, based on what you just said, I would interpolate a 36, 37 VIX. It's not there.
Have we seen that cathartic moment?
No.
Tom, we've talked about that. Have we seen it in sterling? Maybe. Stephen Gallo of BMO says this morning. Darkest before the dawn. Question mark. We think the low for sterling in this cycle is in. That's from Stephen Gallo just moments ago from BMO, Tom. We see a high risk of that low being retested within 1 to 3 months before the cycle in the dollar completely turns. But ultimately, that's the call from Stephen Gallo this morning. His call for the Bank of England, Tom, 75 basis points with a high risk of something close to 100 to 125.
Well, I'm not going to game that out. I think that makes sense based on everything I've read. But what I would say, John, is everyone's publishing. We'll bring everybody up to speed as best we can. And part of that is our guest conversation. Thrilled Daryl Cronk joins in moments.
Got a new consensus, Lisa. You know what it is? Piling into cash. Piling into dollar cash.
Well, that's been the consensus for a while, and yet yesterday's two-year auction didn't go as well as people had expected. So what counts as cash? Is it just, you know, the shortest term U.S. dollar representatives and instruments, or is it somewhere along the curve? And what I find interesting is the consensus maybe is shifting to start buying 10-year treasuries a little bit more.
Just about at 2010 highs. Yeah, pre-measure of TD moving in that direction. Just a little bit. Lisa, I heard the same thing from her.
Yeah. And we heard that yesterday from Steve Whiting over at Citi. Basically, this is the downside risk scenario. People expect there to be some sort of reassertion of the inverse relationship between stocks and bonds, and you're getting actual yields. Should we bring back Terra? You know, there is a reasonable alternative. I just wanted to go there. I think it's beautiful. I think it's really cute.
Is it Terra or Tara?
It's Tara.
Tara. David Kostin stood up in a meeting and said, frankly, I don't give a damn. And they said Tara.
They said Tara. You don't think David Kostin coined that, Tom?
No,
come
on.
On the team
last time I saw him, we're sitting on the couch upstairs. We're talking about 1939, the magic of Wizard of Oz, and Gone with the Wind. And Kostin says he's a giant Gone with the Wind fan.
I'm going to ask him about Tara and Tina. I'll ping him a message on the Bloomberg in a moment. Futures right now on the S&P up a little more than 1%. On the Nasdaq 100 up by 1.3%. It yields back in, lower by 11 basis points, 381.12. We've talked about the weakness in the US dollar, the strength in sterling today. It's a bounce back. Euro dollar kind of bouncing back. Euro dollar positively, so 0.2%, at 96.29.
Who coined Tina? Right? There is no alternative. I don't know. I mean, I'm just wondering who you can give credit to Terra. Who did Tina? Anyway, this is what I'm looking at today. It's not necessarily Terra versus Tina, but Fed speak, lots of it. Everyone, almost everyone. Fed speak includes Chicago Fed President Charlie Evans, Fed Chair Jay Powell in a Bank of France meeting alongside Christine Lagarde. Maybe they'll talk digital currencies. Hopefully, they'll also talk about some other issues that are relevant to the current market condition. James Bullard of the St. Louis Fed, Neil Kashkari of the Minneapolis Fed, Mary Daly of the San Francisco Fed, and Hugh Pill of the Bank of England. This isn't the Fed, this is the Bank of England. It's going to speak around 9:30 a.m. Eastern, which will be interesting following some of the discussion yesterday of whether the Bank of England would come out with some sort of intermeeting intervention. They did not. Do we get more of a sense of what it would take for them to come in if we get some guidance from Hugh Pill? Today, we get a whole host of U.S. data on the housing market, including FHFA and S&P CoreLogic data on home prices as well as new home sales. That's at 9 a.m. and 10 a.m. respectively. How much do we get some retracement in pricing, an actual decline as mortgage rates go up and as people are less willing to buy houses that are less affordable for them? And at 1 p.m., this is important. It is the Treasury auction, yes. $44 billion of 5-year notes. Tom, I know you're excited. The reason why I care, yesterday, the 2-year auction was a bit messier than people had expected. How much demand is there for 5-year yields north of 4%? Is this enough? Is this a reasonable alternative to going into stocks or a reasonable alternative to just going into the dollar? And that will determine where people think perhaps some of the ceilings may be, John, in some of these levels.
I think people are worried about the volatility as well, Lisa. I mean, 2 hours after you could buy into that, you can have a 50 basis point move.
When you get
sure.
full faith and credit instruments moving so incredibly much in one session, it does undermine confidence. So how much do you get some sort of conviction starting to weigh in?
Lisa, thank you. Daryl Cronk joins us now, CIO of Wells Fargo Wealth and Investment Management. Daryl, we've been talking about it around the table, around the desk this morning. This new consensus, not that new, it's been around for a while now, just piling into dollar cash. Daryl, what's the catalyst you want to see to get a sustainable break of this dollar surge we've witnessed through this year?
Yeah, I think you've got to see a couple things. You either got to see peak Fed rate hikes or somewhere at the terminal rate, or you've got to see a turn in the economic data. Otherwise, the U.S. dollar, John, is still going to continue to be strong. It's still king dollar around the world. And as long as the rest of the world's weaker, money's still going to wash ashore and end up in U.S. dollars. So it's hard to make a case. You know, what's interesting about this latest market move is so many times when you get these down moves in the market, it finds itself in things like the credit markets, credit spreads, those type of things. This time it's showing up in currency and in just the rates movement. You can even see a day like today where you're finally getting a bid back in risk assets. Why? Because rates are not going higher and because the currency markets have settled down just a little bit.
Daryl, the religion is V-Bodie. And Boston University finance is simple. Know your underlying math, and the math is calculus and its first and second derivatives. We all know they're out of whack. When you see the rates of change of the U.S. 10-year real yield, we've never seen this. It's made back 83% of the move to the low to a 2.05% 2006 average. How do you interpret and use the rate of change of the real yield?
I think real yields are exactly where it's at, Tom. You're hitting on the exact right moment. The Fed and Chair Powell has been very clear. They want to see the entire yield curve from a real yield standpoint be in positive territory. And we're just not close to that yet. If you use the PCE deflator, which is probably going to be 4.8% of the core later this week when we see the reading, we're not at 4.8% or higher across the curve. In fact, we're not there at any moment in time in the curve, whether you're 1 year all the way out to 30 years. So real yields have to go tighter or higher. And the issue is it's the culmination of all of these tightening conditions. It's interest rate hikes, it's quantitative tightening, it's the US dollar up 20% year over year, it's the fiscal tightening from $3 trillion of budget deficit to $1 trillion, and it's real yields going higher as well. All of that is tightening simultaneously. The Goldman Sachs Financial Conditions Index has gone up 345 basis points this year. That's an immense amount of tightening in financial conditions that's going to show itself where? In risk assets.
So what are you doing with this, Daryl?
So you've got to stay defensive at this point, Lisa. I know that's now where everybody's at. We've been there since the first quarter of this year. We never kind of believed the bear market rallies. We never believed that every time the Fed met, there was a pivot moment coming. We think you still have to overweight fixed income. You stay short duration. You stay up in credit quality. It's not time to reach in high yield yet. And on the equity side, you underweight equities and you stay in defensive sectors like healthcare, staples, utilities, those places, until things turn, until you see the signs turn, or until, Lisa, we reach a price where the risk-reward dynamic changes.
Darryl, just on reflection and just a final question, I think we've played the Fed pause about 5 different times through the summer and into the fall. Darryl, what did people get wrong then that's going to help them identify when we actually get a sustainable pause from the Federal Reserve?
So the interesting thing, John, is if you go back and read the prior Fed meetings with the exception of September, the meeting in March, May, June, and July, every single one of those, the market interpreted as a dovish pivot. And every single time they were wrong. Every single time we rallied off of them, we failed into resistance on some of the technicals, and we ended up at a lower point. So you've got to take the Fed at its face value, right? Everybody's trying to read between the lines and think that there's this pivot coming or dovish pivot. We're finally now getting religion where we've said, okay, soft landing is not possible. It'd probably be a hard landing. You've had the 2 events of the Fed meeting where they really hammered home the hawkish tilt, and then now the UK, who's basically trying to redo the 1970s in the US and do a soft landing with fiscal stimulus, even as inflation rips. We know that doesn't work. We've seen that movie before. So there are things that you can do here, but you got to pay attention to what's happening. Everybody's looking for that moment in time where things turn and the Fed pivots and we're at peak terminal rates. It's just not there yet.
Darryl Cronk of Wells Fargo Wealth and Investment Management. Darryl, always good to catch up with you, sir. Thank you. Doug Cass writes in, not about the Yankees, Tom. You're going to love this. It's about Tata, T-A-T-A.
Yeah.
Treasuries are the alternative.
You ever notice, John, that Lisa gets like 15 times the social response we get?
That's because Lisa is loved
like we're not even,
a lot more
than we
are, Tom. There's good reason for that. You know why.
Somebody called a tiara, and I said, well, yeah, Lisa puts her tiara back on about, 10:05 in the morning. But, it's just humbling, John, how we get crushed every day by Grandma.
I'm truly humbled. Queen of the
I'm
Bears and Queen of the
How
Show
about
as well.
buy low, sell high? Does that work?
Trying to clean this up, Lisa.
Thank you. I'm just trying to hide. Is it working?
Just one big walking HR violation every morning.
I would say that's true, Tom.
Thank you.
Slightly problematic. Futures up 1% on the S&P from New York. This is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian is threatened to become the worst storm to hit Tampa in more than a century. Ian has picked up strength and is now a powerful Category 3 storm. It made landfall in Cuba early today. Ian could reach Florida as early as Wednesday with top winds of 140 miles per hour. More than 300,000 people are expected to evacuate. The British pound is higher today after hitting a record low on Monday. Still, traders remained wary of the chance that sterling could fall to parity with the dollar. The Bank of England indicated it may not act before November to stem a rout in the currency. It's the clearest signal yet that natural gas flows from Russia to Germany over Nord Stream won't resume this winter. The pipeline's operator says that it has sustained unprecedented damage. Leaks have been detected, and markets will be watching for any indication of sabotage. American steel plants are operating at the lowest rate in 20 months. Steel mill use dropped to 76% of U.S. capacity in the week ended September 24th. That's the lowest since January 2021, according to the American Iron and Steel Institute. Executives say mills need to operate at 80% to support profits. And a NASA spacecraft has successfully crashed into an asteroid about 6.8 million miles from Earth. It was a test to determine if the impact can nudge that space rock slightly off course. The U.S. Space Agency is in the early stages of the plan to protect the Earth from asteroids. If measurements show the asteroid's course was even slightly altered, NASA will consider the mission a success. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
I think what we've seen in the reaction to the proposed plan is a real concern and a fear that the new actions will add uncertainty to the economy. You know, one of the things that I spend a lot of time thinking about is how do we create more certainty for consumers?
Raphael Bostic there of the Atlanta Fed. It's kind of bizarre hearing Fed officials talk about the UK being a risk of causing or contributing to a global recession when the Federal Reserve is doing what it's doing, but maybe that's a story for another day. Live from New York City this morning. Good morning. Futures positive by 1% on the S&P, on the Nasdaq 100 up by 1.3%. It's a bounce back. Yields heading lower, negative 12 basis points on a 10-year. It's at 3.8% now on a 10-year, coming very close to 4% in yesterday's session. Dollar showing some weakness after showing a ton of strength. Euro dollar 96.32, euro dollar positive 0.2%. Sterling looks a little something like this. Yesterday, upside down. I talked about the range on sterling from a 103 handle to a 109 in a single day, intraday. Is nuts for a G10 currency. Cable 108, just south of that number right now. Just hearing from Chancellor Quantic.
Yes, of course.
Speaking to financiers and saying we're going to have a credible plan to get debt to GDP falling, Tom, on the regulatory side, saying the following: regulators need to be more nimble.
Sterling not moving on it.
Sure.
I'm watching, looking on the Bloomberg, and I'm really not sure I see much there. As we've said, within this crisis, and yesterday was a crisis, to have Mark Mobius with us earlier on EM is profound. And now, for the City of London, Bob Diamond joins us to say he's founding partner and CEO of Atlas Merchant Bank, barely describes what he did for Barclays. I'll cut to the chase because of time. Go back and look. Did Barclays get a bailout during the crisis? Bob Diamond, thank you so much. Honored to have you here in our studios with Bloomberg today. I'm going to ask one question on the City because John really wants to focus on sterling. There's the City. There's this comedy of Reaganomics redux as well. How does the City, as an international venue, how does it move forward? How does it survive as the global institution?
So this is a really important question, Tom, and I think with all the debate around the announcements that were made in the last couple of days, there is much more support for the City. Something as simple as removing the bankers' bonus caps, which, as you know, was gamed by the banks and put the UK banks at a significant competitive disadvantage to the US banks. Any support for the City right now is important.
But what else would you like to see from this government to bring that kind of enthusiasm back to the City that I think was lost for many people after the Brexit vote?
You know, I think right now credibility is the key. And you know, Simon French said this morning that the only currency that Simon French from Panmure Gordon, the only currency that really matters in the UK macro right now is credibility. And I think the announcement earlier today, which I saw in the Bloomberg headlines, which is that the Chancellor is going to spend time with the banks and the traders and distributors of the gilt market, is important. So I think step one is credibility. Jonathan, if you put this in context, we had a 150 billion debt-financed energy policy without really preparing the gilt market for what was coming in terms of issuance. And I think people talk about the currency crisis. I think this is more a crisis in the gilt market than it was in the currency market.
Well, can you talk a little bit more about what some of those moves in rates would mean for a big bank running a large mortgage book? We saw certain banks remove certain products in the last 24 hours. You, of course, had to oversee a large mortgage book over at Barclays in your time running that bank. Well, can you tell me what you'd have to do when you see rates move this quickly, this fast, and expectations for the Bank of England climb as quickly as they have done?
Well, if you put it in context, Jonathan, the 2-year gilt as recently as August was about 1.5%. You know, right now it's about 4.25. I think it touched 4.5 in the last couple of days. So, to your point, that's a sizable move. That kind of volatility is not necessarily bad for banks, particularly banks with investment banking operations such as Barclays. But what it will do is it will really slow down the issuance of any new mortgages. So the mortgage books, in terms of new issuance, it's going to be, as you said, there was the announcement that a number of banks have really kind of closed their mortgage issuance.
Bob, it's also going to slow down the economy dramatically. What are you expecting in terms of a downturn, a potential response from England, given that the fiscal tool is kind of being blown up and the Bank of England kind of has to push back?
So let's keep it in context. I talked about, I think the communications and the credibility around announcing $150 billion debt-financed energy policy. We talked about those issues, but the other things that were announced, there's some good things in there. I think the announcement around both corporate and personal taxes, keeping corporate taxes at 19% or lowering them 19%, rather than raising them to 25%, puts the UK in a credible position amongst its peers. I think announcing some easing of immigration to ease the labor supply issues. I think some of the things that were announced around kind of infrastructure or reducing the bureaucracy to be able to get to building around infrastructure and around housing. So keeping it in context, there were some positive things that were announced within this. And I think because of the shock to the debt markets, to the gilt markets, we really have to find a way to hold the hands of the markets until late November when the budget is announced and we really get to look at what is meant here by the medium and long-term fiscal program. And somehow we have to manage our way through these markets. And I think the chancellor meeting with the banks today and over the next couple of days is a positive step in that direction.
Do you see some opportunities then?
Absolutely.
Where are they, Bob?
Within the gilt market? Within
sterling-denominated assets more broadly? Take your pick.
Well, look, Jonathan, I want to put that in context as well. People have talked about the currency crisis. The move from 130 down to where the currency is right now has really been about the dollar, the dollar, the dollar. So the UK currency is down maybe 25 or 30%. The dollar's up 20% against every currency in the world. So we need to keep that in context.
Bob Diamond of Atlas Merchants Capital also came very close to saying that he'd be buying sterling and then kind of backed away from it very quickly. Bob, it's good to catch up. Let's have a longer conversation next time. Coming up shortly, Bill Dudley, the former New York Fed president and Bloomberg opinion columnist. Futures right now up about 46 on the S&P, positive by 1.25%, on the Nasdaq up by 1.43%. Tommy, more constructive take on some of the things happening here, and we're going to have to wait for a more complete picture of things because the reaction, of course, has been dominated by the way the market has reacted to this.
I would suggest the banks are completely in every way data dependent, including the Bank of England, which is not only data dependent, but politician dependent as well.
Dudley coming right up. Yields lower by 11 basis points. Your 10-year 381.73 from New York. This is Bloomberg. Equities positive, a nice bounce. Will it stick? We're up more than 1% on the S&P 500. On the Nasdaq 100, up by 1.4%. On a Russell, up 23, up by 1.38%. That's the story in the equity market. You can guess the story in the bond market, can't you? If stocks are up, yields must be lower. They are. They're down 12 basis points on a 2-year. We had 13 consecutive days of a 2-year yield climbing. Now we're backing away to 422. But what a change it's been in the 20s just a year ago, and now 4.2% and some. On a 10-year, down about 11 basis points, 382 yesterday, the highest close since 2010 on a 10-year yield. Just unreal moves in this bond market and in this FX market too. Sterling all over the place from 103.50 back through 109, and cable looks a little something like this now at 108.10. That's a stronger pound, a weaker dollar. That's the story. It's kind of yesterday upside down. Cable positive, a little more than 1%. But in Europe, Lisa, in Europe, we are not out of the woods at all.
No, and it has to do generally with what's going on with gas prices, natural gas, the Nord Stream 1, but it also has to do with some legacy concerns about specific banks. One bank in particular, Credit Suisse, has been in a world of hurt. Those shares hitting a record low yesterday of $4, and this comes as they talk about possible asset sales and selling businesses rather than just a wholesale merger or being acquired. They're kind of running out of options.
We had a 398 today, Tom. A break of four on Credit Suisse. And to Lisa's point, there's all kind of speculation as to what we might hear from this bank, but we get the strategic update, I think, next month.
We need to be careful what we say here. We're not in the business of talking about things with that kind of vector downward.
Sure.
But I would say, John, what it comes down to is regulators in the United States, including our next guest who's very familiar with this, the regulators step in with a vengeance. Is that happening in Zurich?
You know who we need to catch up with, Tom? Mr. Herrog. and fast.
Yeah.
I think we need to have that conversation within the next few weeks
for sure. It's been a really,
sure.
really tough call with a gentleman.
He's been
incredibly
patient.
Well, patient may be it, wrong may be the other word. My good friend David Harrow, of course, the only thing going for him is the Green Bay Packers are getting it done to an extent. Futures up 45, and on the VIX 31.03, a more constructive day. Always constructive are the essays of the gentleman from Berkeley in the New York Fed. William Dudley joins us now, the former Fed president. He's been of uncommon value before, during, and after Jackson Hole. Bill Dudley, markets are moving. The litmus paper of the system, the 10-year real yield, has gone from the bottom 83% up to the pre-Great Financial Crisis level of about a 2.05. How do fancy people like you interpret where the real yield is, how far the real yield has come, and how it nears what seems to be some form of historic normal?
I think it tells you that the Fed is finally getting its arms around making monetary policy tight. Chairman Powell talked about how he needed to see real yields positive throughout the yield curve, and the Fed is moving pretty quickly in that direction. And 75 basis points last week, and they're promising another maybe 125 basis points before the end of the year, taking the federal funds rate well above 4%. So the Fed is catching up. And I think the question at this point is, will they stay the course until they've actually finished the job to get inflation back down to 2%? Powell says he'll do that, but whether the rest of the FOMC will come along with them, I think is an open question at this point.
You, like Richard Clarida, who joined us on Fed Day, know the mathematics, the physics of modern economics, and then you discard it to real-world application. You did that at Goldman Sachs for decades and then at the Fed. I want to talk about the inertial force in this odd word, overshoot. Is it a requirement or is it efficacious that a central bank overshoot a given target?
Well, ideally, you don't overshoot. You do just enough to achieve your objectives. But as you know, monetary policy has a lot of long lags in terms of its effects on the economy, and it's hard to judge those effects in real time. I think the Fed is probably going to ultimately overshoot a bit because they've said that the risks are skewed. The risk of doing too little is much greater than the risk of doing too much, because if you do too little, you end up in the 1970s with a more entrenched inflation problem, and then you have to do even more later. So I think this is the consequence of the Fed being late. If you're late, you have to catch up. If you catch up, you probably are going to overshoot. If you overshoot, you're going to have a recession. I think where I would fault the Fed right now is I don't think they've been realistic about the pain that they're actually going to cause. If you look at their forecast last week, the unemployment rate climbs a little bit. It climbs up to 4.4%, and then inflation melts away. I don't think it's going to be quite so simple as that. There's never been an example of the unemployment rate rising from 3.5% to 4.4%, 0.9 percentage point rise. If it rises more than a half a percentage point, every time that's happened in the post-World War II period, the U.S. has ended up in a full-blown recession. And the smallest rise in the unemployment rate in those situations is 2 percentage points. So I think the Fed is understanding the pain involved. What worries me about that then is that people, when the pain actually arrives, people will start to pressure the Fed not to follow through.
And this is the point of the column that you wrote today, that there seem to be some doubts in your mind and in markets' minds right now, if the market had a mind, that the Fed is going to stay the course. What do you think they have to do to come out and say they're going to stay the course? Or do you think they're not going to, that they're going to pull back on some of the rate hikes, say if unemployment rises above 4.5%?
Well, I think Chair Powell is committed to staying the course. I think he's studied history and knows the consequences of not doing enough. But whether it can bring the rest of the Federal Open Market Committee along with them later. I mean, right now it's easy to be tough, right? Because everybody wants to get inflation down. The labor market's still very strong. And so the pain hasn't really materialized yet. A year from now, when the unemployment rates will quit considerably higher, the economy has slowed, inflation's come down a bit, there's going to be people that are going to start to argue, do we really need to push inflation all the way back to 2%, or can we take a break now?
And how much is this going to be a political pressure on the Fed?
Well, I think the Biden administration will be pretty good about guarding the Fed's independence. Typically, if an administration starts to pick on the Fed, that just unnerves financial markets, and that makes the central bank's job even harder. So I would be surprised if the Biden administration started to attack the Fed. But you already are hearing cries from the left wing of the Democratic Party about how unfair this is, that low-income workers are going to be put out of work, as if there's some alternative. The problem here is that once you're late, you have to catch up. Once you're late, the unemployment rate has to go up. There are no other alternatives. And so it's not as if the Fed has a better path to achieve better outcomes. They need to do what they need to do to get inflation back down. It's just going to be difficult.
If we see services stabilize and maybe reduce, if we see goods come down to the goods disinflation or deflation that we saw pre-pandemic, I guess that means we come back towards John Taylor's 2%. Are you wedded to 2.0%, or can Bill Dudley construct a new normal at 2.8, 2.9, 2. Adam Posen? Where do you stand on that, Bill?
Well, I'm not sure, Tom, if you're talking about the real interest rate or inflation.
Well, I'll go either way. I'll let you make it up. But to me, it's a level that we're aspiring to get to out there.
I think there are some people that say the Fed should raise their inflation target, but I think that's a bad approach right now, because that's like moving the goalpost because you can't achieve your objective.
Done that.
So I think that would undercut the Fed's credibility a lot. And I think Powell has been very clear that his pursuit of 2% inflation from his perspective is unconditional. Whether he can bring the rest of the FOMC along with him when the job starts to become more difficult is really the fundamental question. Right now, markets basically believe Powell. Inflation expectations stay well anchored, but the pain process that's about to unfold is just begun.
That's the domestic pain. The international pain we're witnessing right now, Bill.
Well, that's happened already. Yes, absolutely.
So I wonder, Bill, how you think they should respond to that, if at all.
Well, the reality is they're not going to respond to that, because at the end of the day, monetary policy in the U.S. is about what's best for the United States in terms of the Fed achieving its U.S. inflation and output and employment objectives. Obviously, this creates a lot of pressure on the rest of the world. The stronger dollar holds down U.S. inflation. A weaker foreign currency increases inflation. So the flip side for other countries is much, much tougher.
Messy. Bill, fantastic to catch up. Great piece as always. Bill Dudley there, the former New York Fed president and Bloomberg opinion columnist. Will the Fed stay the course, is the question that Bill is asking here. And Lisa, when he talks about the pain we're likely to see next year, and Chairman Powell has talked about that pain, for me, the next stage of this market is what happens when we realise that pain is happening and yet this Fed is not cutting rates. And for the first time, we could be in what many people might describe as a recession, where the Fed isn't cutting. Sure, they might pause, but they're not cutting rates. They're not doing QE. They're not doing those things. They're not responding to a market mess, a contraction in the economy in the way they traditionally would. This is different.
Bill's point is really, really important, because we've all talked about, well, are some of the Fed projections fanciful in terms of what the unemployment rate will peak out at, right, in order to achieve the inflation rates. He's saying that the fact that there isn't more downside baked into what they're putting out there gives the sense that they haven't necessarily grappled with what they would do with rates if it's worse, if there is more pain in the economy than what they're putting out there, and that's why it's important for them to be transparent and honest about how much downside there really is to this economy with rates where they are.
Tom, Lisa asked about the political pushback. I think it's pretty easy to imagine we're going to see a lot more of that into year-end and early next year.
Yes, no question about it. What I would say here, and Bill Dudley, the class act he is, mentions Claudia Sahm, the great economist from Michigan, in his note today. And, some people will say Claudia Sahm, I'm sure Senator Warren would say Claudia Sahm should be the next chair of the Fed because she's hardwired to the dynamics of the job economy. And, John, the absolute debate we're having is between the late, great Alan Meltzer, UCLA, Carnegie Mellon, and David Blanchflower of Dartmouth. He went to the University of Cardiff, I think. I can't remember, football club. But anyways, John, the point here is Meltzer wants to aggregate the economy, as we heard from Dr. Dudley, and Blanchflower and Sahm are saying this is a much more nuanced labor economy, and that's what Powell's dealing with.
I have no idea that Blanchflower studied at Cardiff Football Club, Tom.
I thought he was on the club. He missed college. I think he skipped college and just played for
Cardiff FC. You know what you need to watch? You need to watch Welcome to Wrexham, Tom.
John, I looked for it last night. I couldn't find it.
Very cool.
I did. I honestly looked for it last night.
Have you got Hulu? I think it's on FX, which you can get on.
I
think maybe Disney Plus.
I couldn't even figure out how to get Yankees
in the UK.
baseball last night.
You're struggling to find that? Let's move. Yankees baseball's been on a different network every other day.
John, I
can't keep up.
I got a Zenith TV with rabbit ears, and I'm just trying to move the rabbit ears around.
Just trying to get a signal.
In.
Keep trying. Futures up 1.3% on the S&P. This is Bloomberg.
The
keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, Hurricane Ian has now turned into a powerful Category 3 storm as it takes aim at Florida. Ian made landfall in Cuba early today. It's now on track to become the worst storm to hit Tampa in more than a century. Hurricane conditions could arrive in Florida Wednesday morning with winds of up to 140 miles an hour. A meeting today between Chancellor of the Exchequer Kwasi Kwarteng and top British financiers could be difficult. Since Kwarteng introduced his mini budget on Friday, the pound has plunged and shares in British banks and insurers have been battered. Those attending the meeting will want answers on how Kwarteng can restore investor confidence. Senate Democrats have proposed a short-term funding bill aimed at averting a government shutdown. Congress must pass the measure by midnight Friday, but the package includes a measure to speed up energy permits. That's opposed by most Republicans and some Democrats. Leaders of both parties are anxious to avoid a shutdown a little more than a month before midterm elections. Goldman Sachs has sharply lowered its oil price forecast. Still, the firm says it remains bullish because of a tight market. Goldman predicts Brent crude will average $100 a barrel in the last 3 months of the year. Now, that's higher than today's price, but below its previous forecast of $125. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The Bank of England has been late in raising rates and in too small amounts. So if one is to point one's finger at an institution that perhaps could have performed better, it is the Bank of England. We're thinking in terms of a recession that will be deep and long. It's the price we have to pay for financial stability and for getting on the right track.
The next Bank of England decision, November 3rd. David Folkerslanter there of Deutsche Bank, the chief economist, live from New York this morning. Good morning. Futures positive by a little more than 1% on the S&P, close to 1.5 percentage points higher. Yields are lower by, let's call it 12 basis points now, 3.8% on the US 10-year. The euro a little stronger, dollar a whole lot weaker, euro dollar 96.47, and a big turnaround, Tom, in the last 24 hours on pound sterling, something in and around 108.
Yeah, big turnaround to me is 109, 110. I'm not sure we're there yet, but certainly the gloom of yesterday, John, is a bit removed. There's no question about that, and it sums up, and you see it even in EM with a little bit of, a little bit of kindness there. Can I suggest maybe started by Charles Evans this morning?
You can suggest whatever you'd like to suggest, Tom. Certainly it's a change on sterling. Cable was 103.50 at the lows yesterday, and through 109 in the last 24 hours.
John, I remember you telling me Ryanair at 3 whatever on the Irish RYAID. You said buy it at 3, and it went 3 to 18. I mean, that's what Ryanair did.
Did you buy it?
No, I didn't.
Okay.
I mean, and it's been down in pandemic and all that, and somehow survives to move forward, and does so with one of the most extraordinary chief executive officers, Mr. Michael O'Leary, who's been medicated over the last 3 days and joins us this morning. Michael, John and Lisa have some very important British questions. I want to ask you what matters to every viewer and every listener right now, and you own the high ground on this. If we don't fly business class, we won't fly. This new addiction to business class versus economy, which you own the high ground on, where are we in a couple years with our addiction to business class, like New York to Paris, $18,000?
I mean, it's a good question, but there's two different markets here. Business class will continue on long haul. It's a different business model, but business class has disappeared on North American domestic, and business class has disappeared on trans-European as well. People will not pay a ludicrous premium on 1 and 2 hour flights to be stuck in some hub airport that resembles the black hole of Calcutta, as Heathrow, Schiphol, and Paris Charles de Gaulle have much of this year. Happily, the vast majority of European passengers have switched sensibly to Ryanair for the most on-time flights, the lowest airfares, and a brilliant and safe service.
Every time we speak, Michael, there's always a pitch. There's always a sales pitch. Let's talk about immigration, Michael, and this new government. You've complained about it for so long. We've got an opportunity for change. What do you want to see happen?
Well, you're particularly talking about the UK government.
I am, yeah.
The latest version. Okay. the UK government, Brexit has been the greatest economic foot shooting in the history of economic development since the Second World War. It is the stupidest, dumbest economic activity known to mankind. It was led by Boris Johnson, Michael Gove, and a number of other legendary idiots who decided that the way forward for the UK economy was to leave the biggest trading bloc in the world. Now, there's no point in arguing over Brexit. Brexit has happened. But at least if you're going to leave the European Union, leave with the most intelligent free trade agreement in place with the European Union. Of course, what these morons did was they left with the worst trade agreement in place. And they had the remarkable situation that we're one of the biggest employers in the UK. We employ more than 8,000 pilots and cabin crew in the UK. This year, all of the airlines are struggling to recruit people because a lot of English people don't want to work in a service industry like the airline industry, despite our high pay. We couldn't get visas for Europeans. They would give us visas for non-Europeans, but not for Europeans, because they want to take back control of their border. Now, they don't have much control because there's about 1,000 refugees each day coming across in dinghies from France. Apparently, they're fleeing persecution in France. Who knew that France was such a terrible country? But it is the UK is currently a country that has no labour policy. And the restrictions in the labour market are inhibiting growth, never mind the crazy budget they've just announced last week.
Michael, it's clear that you have some pretty strong feelings about this. I can say that. And it's nice that you can share them with us. Your perspective as one of the biggest employers in the United Kingdom, how much, as things are now with the labour policies currently in place, how much have wages gone up on average for you? And do you expect them to keep climbing with no change into the year?
Funny enough, wages haven't gone up that much. I mean, there's clearly upward pressure on wages because of pay inflation. But, the challenge for a lot of industries in the UK, whether it's retail, hospitality, air transport, is wages haven't gone up because nobody wants to do the jobs. Even if you increase the pay, people still don't want to do the jobs. We're bringing in people from Morocco and from Turkey, and we can get visas for those guys to work in the UK, but they won't give us visas for Portuguese, Italians, Germans, and Polish people. It's a crazy system. But I'm pleased to say that lots of people are fleeing the UK. All of them are flying with Ryanair on very low airfares to more than 200 destinations all over Europe and saving a fortune, making a fortune, taking up well-paid jobs all over Europe.
Michael, I don't think Liz Truss is calling you anytime soon after this one.
I bloody hope not.
But revenue at Bloomberg's going to call for the two advertisements.
Michael, I want to squeeze in a foreign exchange question if we can. Can you just tell me as a CEO, given the moves we've seen in pound sterling, in the euro, given some of the costs in US dollars, how have you hedged any of that? What have you done? Have you had to adjust to that story?
Yeah, I mean, the UK sterling, we're reasonably insulated because we have we essentially balance our sterling revenues with sterling costs. As I said, like we employ about 8,000 people in the UK. We have a lot of airport and handling costs in the UK. We are short euros, long dollar. Thankfully, in Ryanair, we've been very fortunate. We've hedged our dollar exposure on all of our capex. We've ordered more than 200 aircraft from Boeing out to 2026. We hedged all that at 124 to dollar euro 124. So we are significant beneficiaries of that. I think the real challenge for a lot of our competitors in Europe is they're not hedged on the dollar, and therefore they're paying about 25% more in terms of cost for their aircraft and their spares. Thankfully, we've largely hedged on capex. Our OPEX is hedged out until the middle of 2023, which would largely be oil. And we hedged the oil as well. So we bought out to next April at about $64 a barrel. So we've been lucky and fortunate in being very well hedged, but a lot of our competitors in Europe who are buying US dollar assets, and for the airline industry, aircraft fuel and spares are all in dollars. It's a very difficult time.
Michael, let's spend some more time next time, a longer conversation about the mess that Europe is in. And you let me know if the Prime Minister gives you a call.
Europe is okay. Europe is growing strongly, and Europe will do well.
Looking at Germany right now, Michael, I'm sure other people might have a different view on that. Michael O'Leary of Ryanair. Michael, thank you, sir, as always. Do you think the Chancellor's going to give him a call anytime soon, Tom?
John, I'm looking at Sardinia to Dublin, Dublin to Sardinia. Why aren't we doing this, John?
You want to do a Ryanair tour?
I mean, I'm looking at $145 round trip. Throw in $93 for the Flexi Plus. It's a steal.
Futures positive, 1.4%. This is Bloomberg.
We know what the Fed is looking at. They're looking at the labor market. They're looking at end user demand.
It's going to come at the expense of the labor market, but we're not going to have long-term inflation instability.
I don't think they're going to blink anytime soon.
I look at the Fed's economic projections. They seem almost fantastical to me.
We haven't seen really the economic impact of most of the tightening.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. It's a Recovery Tuesday. We found a bull. She'll join us here in a moment. John, bulled up is, well, the Chancellor of the Exchequer out with recent headlines. Pound doesn't move.
Yeah, speaking to financiers and talking about bringing debt to GDP and that ratio lower. Tom, there's a lot to play out here in the UK. We'll get a fuller budget in due course. We'll also hear from the Bank of England in early November. Lisa talked about this in the last few hours. We'll hear from the chief economist in about 90 minutes from now, so looking forward to that.
Hugh Pill of Stanford University. That'll be interesting to hear. And John, what's so important to me is this redounds not just about the United Kingdom, comes right over to the United States, comes right over to EM. Hungary moments ago, moving that interest rate 13% versus an estimate of 12.75%. John, we're going to see a lot of that.
The chairman of the Federal Reserve has talked about the prospect of pain domestically. That pain is already playing out on a global stage. We're seeing that across a range of currencies, and a whole host of central banks has to respond to it. Tom, can they respond to it? Can they do anything about it? Because at the moment, yes, today's a different story, but the dollar has been so dominant through much of this year.
Let's cut to the tension, John. Charles Evans beginning to frame what if, and Bill Dudley on moments ago saying, no, stay the course and overshoot. I mean, it's as simple as that in the U.S.
Tom, the bear case at the start of the year is the best case now. That's the best case, that maybe unemployment gets to 4.5% and we don't have a recession. That's the Federal Reserve's best case now, Tom. That just tells you how much things have changed in 10 months.
For Bozy 101, let's jump right to it right now with Lisa Abramowicz. And we do it with the rates of change in the bond market. El Arian out, Lisa, saying bonds matter more than FX. And what's so important here are the dynamics of how fast we're moving in yield. What do spreads tell you?
Well, what's happening right now when you talk about the United Kingdom, for example, is the biggest five-day sell-off ever in a five-year bonds over in the United Kingdom. In the spread market, in the corporate debt market, you aren't seeing some sort of wholesale crisis, which is the reason why some people are saying this could last longer. And to Bill Dudley's point, the Fed is not going to blink. And if they were to put out a bit more dire projection of what to expect in the U.S. economy, perhaps people would understand that.
What happens in the auctions? We make a joke about it, folks, but actually, I get the shtick. Lisa is serious about the auctions. They didn't go well yesterday. Why is that important?
It's important because there isn't a screaming demand that came into play to buy two-year bonds even as yields were rising, even as people were getting income, and even as you hear a consensus across Wall Street go to the short end of the yield curve. This spurred the further leg upward in yields in the 10-year, further downwards in price. How much do we have some conviction buying? That seems to be what's driving a lot of the move today in risk assets. Suddenly, people are coming back into bonds, which gives perhaps a floor, but then goes back to this question of, well, then how does the Fed do its job?
Let's have conviction in our data check. John, I'm going to go to the 10-year real yield from a negative 1.11 skyrockets up to a 1.60, down right now, 1.50. But John, the speed of movement in the inflation-adjusted yield infects all of the data checks.
So fast. The nominal yield comes down 10 basis points today at 3.82 on a 10-year. Yesterday, we closed at the highest level since 2010. We break the losing streak, hopefully on the S&P 500, if you are an equity market bull. We bounce back from the lows of the year on the S&P. We're higher on futures by 1.29%. Talked a lot about that dollar strength, this dollar weakness with yields lower. Euro dollar 96.40, that currency pair firmer, Tom, by a third of 1%.
Interesting to see. Let's get right to an important conversation. Within your collective gloom, Victoria Fernandez says no. Chief market strategist across market. She is in the trenches of what do you actually do with money. Victoria, you say no to cash. Why?
Yeah, I mean, look, Tom, when we talked a couple weeks ago, we had increased our cash position a little bit because we felt like we would get some inflection point, and that would be an opportunity to go in and shift the portfolio a little bit. And so that's what we're doing. We're using up that cash. We're putting a little more beta, a little more cyclicality into our portfolios. I'm not a raging bull at this point, but I think you can take a little defense out of your portfolio and start building it up again as we're probably getting closer to a bottom. We haven't hit a lot of those metrics that people are looking for. We have a negative earnings yield. You typically don't hit a bottom with a negative earnings yield, but we're also not in there trying to time the bottom exactly. We think use some of the events like we've seen this week to start building more positions in your portfolio.
Does that mean buy the banks?
So we're not buying banks per se, but we are buying credit cards. We like Visa. We like American Express. We're buying some of the energy names too. As you know, we've been underweight energy for a while, and we've been building that position, but we've added quite a bit. We've added to Phillips 66, ExxonMobil, Valero. We've gone in and added a lot to those names, and even more cyclical names like UPS. I know a lot of people didn't want to be in the space after the things that FedEx said, but we think that that was more idiosyncratic for FedEx, and we think there's some opportunity in the fourth quarter for a company like UPS as well.
What about Facebook, Google, Amazon?
Yeah, so those high-flying tech names, those communication services names, I think that's really where you've got to be careful. We have some exposure to those FANG names, but it's not an area that we're adding to right now. I think you have to be very careful on those because there's probably more downside as yields continue to go higher on those. I think if you're going to play in that space, Apple is probably your safer bet at this point in time. They just closed out their fiscal year end over the weekend, and from what we're seeing from analysts, they had a pretty strong year. So I know a lot of people are waiting for Apple to make the big turn to say we've hit the bottom. I'm not sure we see that in their earnings coming out after this quarter end.
Victoria, I want to understand your parameters. We've been talking a lot about the Fed pivot and whether that's sort of underpinning some of the bullish sentiment that we hear on the fringes of Wall Street, not necessarily mainstream. What's underpinning your conviction that we're getting close to a bottom?
Well, I think a lot of it has to do with the momentum that we've seen, the trend lines that we're watching. There's a lot of contrarian signals out there. You look at the bull-bear ratio, you look at the put-call spike ratio. I know that Tom was mentioning the VIX earlier this morning, and we're surprised the VIX isn't higher than where it is, but we want to see the VIX continue to move higher in the with a 3 handle. So I think you have to look at a lot of these trends and say we're getting close to where we think we need to be.
Victoria, Crossmark's clients, like everywhere else, are absolutely shell-shocked with the news flow, all the nuances of it. It comes down to revenue and the dynamics of unit and price. How important is revenue into this earnings season?
It's extremely important because it's going to tell us what the margins look like. I mean, one of the themes that we just talked about last week in our investment committee for all of our strategies was quality of earnings and quality of balance sheet. And so revenue is highly important. We know with prices being higher, that top line will be there. It comes down to what do those margins look like? And look, EPS, the expectations for this quarter have come down from north of 9% to right around north of 3% for the quarter. But I still think they're going to be strong enough to hold up the market until the Fed pushes us over a cliff.
John, Victoria's next investment management committee happens to be in the great state of Alabama. It's Texas A&M, Alabama.
Nice.
That's happening October 8th. You think we could make it down
I've been
to meet the
wondering
good
for a
people
while.
at Crossmark?
I want to go and watch Bama play, Tom. I'm told it's the closest
A&M,
thing to European
Victoria
football.
Fernandez, come on, it works.
Victoria, can we make that happen?
Let's go. Y'all come on down.
We're going to do a surveillance special. Do you like that, Tom?
love
You'll come on down.
Absolutely.
I feel like Victoria put that on just then.
The fighting Texas Aggies.
Victoria Fernandez, across Mark Global Investments. Love that. Need to go and do that, Bramo. That'd be fun.
Yeah, and actually, y'all is a really good sort of gender-neutral y'all.
Yeah, well,
good
that's good.
Being,
It's common on the Upper West Side.
Yeah, we're going to try to incorporate that into Bloomberg surveillance.
Is that what we're going to do? Y'all.
Y'all take a look at those markets.
Y'all take a look at those markets right now.
Doesn't sound right coming out of your mouth.
That wasn't an accent. I wouldn't even try. 1.29% higher on the S&P 500. It makes me wonder, thematically, this is something we're going to focus on in the weeks and months to come. We're talking about buying equities before credit has potentially blown out, which is something that Bob Michael at JP Morgan Asset Management is pushing back against. Lisa, if we're going into a recession at a time when the Federal Reserve will not be cutting interest rates, and if we've blown up a decade worth of low interest rates, ZIRP, negative rates, QE, and all of the above, I'd be asking a simple question. Where are the bankruptcies? When do they start to pick up in a material way?
Some people say that there won't be as many this time just because companies have termed out their debt. But that can't insulate everybody. And that only works until the middle of next year when there starts to be a bit of a pressure point in terms of refinancing. So you're right. And you know, Tom asked me earlier about the spread market. I'm surprised there isn't more of a sell-off in high yield. In investment grade is where you're seeing yields climb to the highest levels going back to 2009, all in because of the treasury yield and the spread component. In high yield, it's not that extreme. And that, to me, raises some questions.
So it's through 500. And Bob Michael talked about, what was it, 750?
750.
And all in, was it 12%, something like that? The yield on high yield before he thinks about stepping in. He basically said, be patient. Recession's not here yet. Wait for it.
And right now we're looking at an all-in yield of 9.5% for high yield, which people think looks pretty good. But he's saying it's going to get better. So hold on. And a lot of people are on his side with that, actually.
Wait for the pain, Tom. Seems to be the message from some people, at least. In fixed income, it's not here yet.
Say it's massively nonlinear, and we're at a point here at 1.50, 10-year real yield, where you've got massive nonlinear impact as you go up to that 2.05 level that I calculated this morning. And John, it's unimaginable if you get a 10-year real yield over 2.05%, the effect on the zombie corporations of America.
It is Turnaround Tuesday, everybody. At the moment, at least, anyway, up by 1.3%.
The conviction there.
Nothing sticks, Bramo. You know the story here.
The conviction that
I'll get to the opening bell at 9:30, and everyone was saying, you said it was Turnaround Tuesday.
Yeah.
Down.
No one said that.
I've got no idea.
Wednesday.
People say that every day.
Seriously?
Every
Is that the
day.
reason why
It's
you're
like online bullying on Twitter. It's every day.
Wednesday,
Every day.
John, Wednesday is Conviction Wednesday.
It's Conviction Wednesday.
It is
Conviction about what,
Wednesday.
Tom?
Just conviction in our beliefs.
Just
we
general
believe.
conviction. Okay.
We will
be convicted tomorrow.
We would
took it south.
Not that. Anyway, from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian is threatening to become the worst storm to hit Tampa in more than a century. Ian has picked up strength and is now a powerful Category 3 storm. It made landfall in Cuba early today. Ian could reach Florida as early as Wednesday with top winds of 140 miles per hour. More than 300,000 people are expected to evacuate. The British pound is higher today after hitting a record low on Monday. Still, traders remained wary of the chance that sterling could fall to parity with the dollar. The Bank of England indicated it may not act before November to stem a rout in the currency. Germany suspects sabotage is the reason for damage to the Nord Stream pipeline that carries Russian gas to Europe. Now, a German security official told Bloomberg the evidence points to a violent act. The operator of the pipeline called the damage unprecedented. It's the clearest signal yet that Europe will have to survive this winter without any significant Russian gas flows. Vladimir Putin's mobilization is hitting Russia's economy in its weak spots. Putin has called up 300,000 men to fight in his war in Ukraine. The order takes about 1% of the country's active workers from their jobs at a time where there are few candidates to replace them. Plus, the move is likely to batter Russians' fragile finances, leaving some of the draftees' families short of cash. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
The median SEP projection is for the federal funds rate to be in the range of 4.25% to 4.5% by the end of this year. Though I would note almost as many FOMC participants wrote down 4 to 4.25% for the end of year numbers. So most think we're looking at something like 100 to 125 basis points of rate increases this calendar year.
That's the view on the Federal Reserve. Charles Evans, the Chicago Fed president, going through the Fed forecast live from New York City this morning. Good morning. Your market bouncing back on the S&P, on the Nasdaq. On the S&P up by 1.4%. On the Nasdaq 100 positive by 1.65%. Yields are lower by 12 basis points. 380 on a 10-year after coming very, very close to a 4% number on the US 10-year yield. Tom, yields at the highest level since 2010 at yesterday's close. On a 10-year, on a 2-year, the highest since August 2007 at the close yesterday. We back away at the front end as well.
John, I'm glad you bring this up. The significance of a 4.00 on the 10-year, I'm not sure it's not like the 2-year. I mean, it's not that big a deal. Am I right?
Tom, it's significant in the sense that many people thought we'd seen the high back on June 14th.
Okay, fair.
And we've added maybe 40, 50 basis
Are we
points
framing
to that.
5? Are we framing 5% now?
That was the question we were asking 3 months ago about 4.
Yeah,
and here
exactly.
we are. So,
yeah.
Tom, who knows? I think we've got to be very humble about the moment we're in this market, in this economy.
We're humble, and we're waiting for Conviction Wednesday, which we'll do tomorrow. One conviction we have is that Leland Miller owns a high ground on the analysis of China. His China beige book is absolutely definitive. We're honored that he could join us this morning on the granularity of China. There is an article, Leland Miller, I featured in Foreign Affairs magazine, The Weakness of Xi Jinping, How Hubris and Paranoia Threaten China's Future. It is a courageous article, without question putting the author at risk. She talks in there about pedigree and reputation of family as the only driving force of leadership. Do we overestimate Xi's ability, or is he just a part of the machine that makes pedigree and reputation advance?
Well, I think that what Xi has been doing over the last 5 to 10 years has been making the machine part of him, whether it's putting Xi thought into the party constitution, replacing senior army officials or party officials with people who are loyal to him. So he is building the system around himself, which of course helps him stay secure for a while. But the problem with this is, as you go on and as the Chinese economy faces bigger challenges in the future, Xi's seen as China. So China's economy is Xi's economy, and any downturns, any problems are going to be associated with Xi. So what it does is keep him secure in the short term, but it could cause a lot of problems down the road.
Tell us the prism you have of the party Congress that is upcoming. What is the nuance, the distinction we need to study?
I think that people are looking at this for signs of trouble for Xi, and I think that's the wrong way to look at it. There's this idea that the party Congress is a pivot point. It's a pivot point for economic policy. It's a pivot point for COVID-0 policy. I think both of those are wrong. Maybe you see tweaks to COVID-0. Maybe you see a little bit more stimulus the second half of the year. But we have entered a paradigm shift in China's economy, in China's governance, in terms of China's stimulus playbook. This is the new China, and these are the challenges that Xi is going to have to deal with. So I think more we're looking at what he does with the officials just under him. How is he laying the groundwork for a world after Xi, or is he not going to do that at all?
Leland, where does the currency sit in this new regime, given that we've surpassed that seven per dollar yuan, onshore yuan level, and continued to go further? How much do they want to push back? How much will this administration allow a weakening in the onshore yuan at a time when they have to be concerned about inflation and they have to be concerned about growth?
Yeah, there's a lot of concerns. Inflation's one of them, but not the biggest. I think that in a super strong dollar world, there are limitations to what the PBOC can do. And so the major focus right now is looking at the party Congress. I think that there is a preference by the PBOC not to have 7.2 broken, actually 7.18 broken, because that was the low of a couple years ago. If you break that, then you're signifying that maybe China under COVID-0 is worse than China under COVID, which is not something that I think Xi Jinping wants to signal to the world. But beyond the 7.2 mark, we're looking at the dollar as the story. And the PBOC will push back against this. They don't want a big one-off devaluation. They don't want rapid depreciation. So they'll hold the line as much as they can. But there's a limit to this, and it's going to depend on how long the dollar is strong.
Leland, earlier this year, you came on the show and you said we could see sub 2% growth in China. The rest of the market is coming your way. They are seeing that as a more realistic type of assessment versus the 5% targets that we heard earlier in the year. Where do you think we'll end this year, and where are we headed next year for Chinese growth?
Well, I think a lot of it depends on what the narrative can be spelled around COVID-0. Are they going to enter into big lockdowns this winter, which is very possible considering this, the spread of the current variant. Look, the reason we talked about sub 2% growth being a very strong possibility is that there's this idea that as soon as COVID-0 lockdowns in the spring were suppressed, that you'd have a bounce back in growth. But we're not seeing any of that, because what firms have been telling us, we're talking about tens of thousands of firms over the course of the past year. They have been telling us that until the COVID-0 nightmare is over, they are not going to borrow, they're not going to invest, they're not going to hire. And indeed, all of those metrics were worse in our recent Q3 data. Borrowing hit the lowest level we've ever seen. Firms don't want to plan for the future if they don't know the future. And to know the future, they need to get rid of COVID zero.
So, Leland, to some extent, this has some of the characteristics of a balance sheet recession. And Leland, I wonder if that's easily undone by just saying COVID zero is over.
If that was all that was happening, I think that yes, and you probably will see about. Certainly, markets will love it the second that the party signals that COVID zero is coming to an end sometime soon. But the reality is that you've also got a structural deceleration in the economy. Property has been taken out as a growth driver going forward, so you're going to have much slower growth, completely independent of anything that's happening with COVID. There are not replacement growth drivers. So the challenges here is they're trying to conduct a whole bunch of very big structural changes to the economy, shift from investment to consumption, but they're not putting in place the kinds of policies that would incentivize consumption to rise. So you've got this very difficult situation where you're shifting away from the old levels of growth, but you don't have immediately obvious new growth drivers. So this is the challenge. You're not going to see a growth spike up in the years to come. You're going to see a new era of much slower growth.
Leland, thank you, sir, and congratulations, as Lisa pointed out, on just a phenomenal call earlier this year. Leland Miller of the China Beige Book International. Lisa, when people were talking about 2 and Leland was 1, maybe a break of 2% GDP growth at the start of the year, some people thought he was nuts.
And now they are moving in his direction.
Very much so.
What if they move in his direction with the next couple of years, the next decade of very subdued growth in China? What does that look like for the world?
Shahab Jananous of Credit Suisse is going to join us shortly. Looking forward to that conversation on the FX market. What a messy couple of weeks it's been. Futures bouncing back up 1.4% on the S&P from New York. This is Bloomberg. New lows for 2022 at the close yesterday on the S&P 500. We bounced right back off them. On the S&P, we bounced back by 1.3%. On the Nasdaq 100, up by 1.55. Yields are lower. They're negative 11 basis points on a 10-year, 381.73. The dollar's weaker in line with that. The euro stronger. Euro dollar 96.37, positive a third of 1%. Sterling, big turnaround, 103.50. Yesterday morning, all-time low on cable, back to 107.94, and at one point through 109. That currency pair positive about 1% this morning. George Saravelos of Deutsche Bank done some fascinating work over the last week on this. This is what he said in his most recent note. What is the clearing level of UK asset prices, gilt specifically, at which investors would be willing to fund the UK? He calls this the critical question, and most people would agree with him. He said the market is itself already attempting to answer a record low in the exchange rate, a near 2% rate hike by early November, and a 6% terminal rate from the Bank of England. Goes on to say, if this is not delivered, it risks further currency weakening, further imported inflation, and further tightening, a vicious cycle. And Tom, it's that vicious cycle that can become quite self-fulfilling, and that's the one we need a circuit breaker for right now.
Absolutely. And on trade-weighted sterling back to the time of John Major in 1992, that gets your attention, which is a good time to check in with Shahab Jananous. He's Chief Foreign Exchange Rates and Strategist at Credit Suisse this morning. Shahab, I want to go to where Mark McCormick over at TD wrote up a great note off their London desk yesterday. I know you've studied this as well, which is a nation's flows is signaled by the current account balance. And there's all this mumbo-jumbo in FX, mumbo-jumbo in financial TV and radio and all that, which ignores the obligations a nation has given flows. How naive is the trust administration, the trust government, on the state of the current account balances in the United Kingdom?
I think they made assumptions that the market would like the policy mix that they're putting forward, that you could argue really overlooked the underlying conditions for trade in the UK. We had a current account deficit that was already above 8% of GDP.
Stunning.
If you add to that an enormous fiscal expansion, then clearly you're looking at that going to double digits. Very difficult to sustain the capital inflows the country needs if you have interest rates below the U.S., for example. You need a premium over the U.S.
Okay, we talk about this in America. It was my chart of the year, 2 consecutive years in a row. The twin deficits of America. Stephen Roach and others have written this up over the decades. Is there an awareness in the United Kingdom that you observe in the city over the twin deficit state of the United Kingdom?
I think overall this year, an interesting feature has been a lack of focus on trade flows more generally, not just in the UK. I think it's a key reason why other currencies like the euro are weak as well, as we've discussed in the past. But in the UK, this is now a very pressing issue. I think the market clearly understands what's happening. That's why it's requiring these rate shifts from the Bank of England that so far aren't being delivered. So the market understands that. I don't think the UK government has prepared the UK public for that. The messaging there is different. Now, maybe at some point we're going to square the circle. I assume the UK government will have to come out with plans that involve some form of fiscal tightening in the medium term. Some areas of the economy will need to see tightness on that front. That might not be popular either. So we'll have to see how that works out. But it's going to be a rough couple of months, I think, for the government.
Shahab, one thing we've said on this programme is to really draw a distinction between an adjustment, a market adjustment through a weaker pound sterling, higher gilt yields to attract capital to fund deficit, and something much, much worse than that, a negative self-fulfilling downward spiral in the currency, an upward spiral in the gilt yield. Is it the former or the latter? Because I'm not sure many people are on board with the idea just yet that it is a crisis of the latter, and perhaps it's just the former, that we've got to that clearing price, we needed a weaker pound, much higher gilt yields, and here we are.
Well, I think the problem is really the Bank of England's base rate is still not very high relative to what the market needs to see. And the problem is the Bank of England has consistently failed to meet what the market has priced in for where rates should be in the UK, even before the government announced these latest fiscal measures. So the track record is not good there. And when you compare that to other central banks, for example, let's take the SNB, where they got well ahead of the game very quickly, and even referenced yesterday, Meshler from the SNB specifically referenced what the markets have priced in for Swiss rates as something that they're noting and trying to keep up with. That's a very different message to what we've had from the Bank of England, which has been constantly to try to push against market pricing. And I think that's a big problem in a world where you have choices in terms of where you invest. And it puts the UK in a bad light, in my view.
That raises a really important question then. If there is a bigger credibility deficit right now, is it in Westminster or in the city?
I think the problem at the moment is both the Treasury or the government with its fiscal plans and the Bank of England with its lagging monetary policy. Both have a credibility problem in terms of where financial markets stand, and they both have this problem certainly with respect to competitor nations that are also looking for capital. So trying to keep UK capital in the UK could become the next problem, let alone trying to attract foreign capital into the UK. So I think the Bank of England needs to signal very clearly that it's prepared to take rates well above Fed funds rates, for example, in the US. And that needs to come soon. I don't think we have a lot of time to wait for this to come through. And waiting around till November is definitely a high-risk game.
So what's your conviction level in terms of levels, in terms of where the pound can weaken to before something steps in that's a little bit more crisis-like and a little bit less market discovery of new levels?
Well, I think somehow the Bank of England did buy time with its statement yesterday, suggesting that it's prepared to act as needed. I still have my doubts about whether really we can wait till November for the bank to act, and November 23rd for the Chancellor to come up with a medium-term fiscal plan. I assume we'll see in the weeks to come some form of early insight into what kind of plans the government has to reassure the city, to reassure financial markets. But I think the path of least resistance is a move back down to the record lows that we set yesterday, and unless something changes very quickly.
And how much is this a UK story? How much is this a dollar story? And it's an important question because a lot of people have been saying this is the final throes of the dollar ascendance and that we're going to see some sort of washout and then a bit of a retracement. Do you buy into that?
I don't think it's just a dollar story because the pound is weak against a whole range of currencies at the moment. So even against the euro, the pound is weak, as Tom mentioned, on a trade-weighted basis. Sterling is doing poorly. So there's clearly some important UK element in what's going on here. And I think that's the real problem here as far as the UK government is concerned. It's very difficult to pin this down on just general dollar strength.
Where's the trade in the Pacific Rim right now? Where's the opportunity to make a big figure move north-south Pacific Rim?
We're still looking for dollar gains against the Chinese currency, for example, against the renminbi.
Really?
We're still looking for dollar Korea to go up.
750?
We're looking for 725 as the next step
Wow.
in that currency pair. We've been consistently bullish dollars against the renminbi.
Is that destabilizing for Beijing, or is it a fiction where they really don't care? They don't care about Dornbusch or anybody else?
I think at the moment, there's a sense that because the Chinese economy is not doing so well, because of the zero COVID policy and other issues as well, and because the dollar is strong globally, there's a tolerance for the Chinese renminbi weakening without necessarily creating a sense of panic.
Sharp, just quickly, BMO, Stephen Gallo said we've seen the low of the year potentially in cable, 103.50. Do you think we have? It's the low in?
I think we can go lower than that, to be honest with you, unless something changes on policy. I do believe that it's very, very important now, especially from the Bank of England's perspective, to come in and reassure markets that interest rates will go to where they need to be to make the overall metrics work out in terms of the balance of payments, and in terms of attracting net capital inflows into the UK. Unless that happens, I do think we can go through the lows of the year.
November 3rd, the next scheduled meeting for the Bank of England. I was very precise with my words then for a reason, the next scheduled meeting for the Bank of England, because, Lisa, some people think maybe they meet before that. Shahab Jalanous there of Credit Suisse. The Chancellor met with asset management and insurance firms in the City of London today. Just got a tweet from the Treasury in the UK. He met them and reiterated, Lisa, the government's commitment to fiscal sustainability. Next month, he will set out a package of regulatory reforms for the UK's financial services sector to drive growth and incentivise investment. One thing that's got lost in a lot of the conversation about what the UK government has done over the last couple of weeks, and rightfully so, we've focused on what's happened in the markets, but also prioritising the city and financial services in the UK is for a very good reason. It makes up a large chunk of the UK economy, Lisa, and it's certainly not a bad thing that we're focusing on supporting that.
And Bob Diamond was pretty adamant about this, that there's some really good aspects to some of their growth plans that will support the sustainability of the nation. It's just, do they have the time to wait to set out those proposals as pound falls out of bed? I don't know.
And will the market cooperate more broadly to the bond market too? Can I share my lineup with you for the next hour?
Please do.
Around the opening bell, Mike Wilson of Morgan Stanley. Looking forward to that. The man has been right for much of this year. We'll break down this equity market with him at 9:30 Eastern Time. Going into that, we're going to catch up with Judy Beale of Kane Anderson Rudnick and Luke Hickmore of, how do you say Aberdeen, Tom?
Aberdeen.
Without the vowels. Do that again. Aberdeen. Anyway, we'll catch up with Luke if he still wants to join us in 20 minutes. A man who's got to manage, Lisa, sterling-denominated assets, so that's an important conversation.
Well, can I just bring this to you? There was a story today on Bloomberg talking about how electric blankets, that the sales of them are surging in the United Kingdom ahead of the winter.
That's no joke, is it?
It's no joke. And that the prices are skyrocketing because people are preparing for less heat and saving money on those bills.
We can joke about some of these moves, but that is no joke. And Europe's going to have a very difficult winter too. And one thing we've also got to talk about as well, Lisa, is just the bear case becoming a base case in Europe to see Nord Stream 1 down and no hope from some people that it comes back online.
Which is a reason why perhaps there isn't necessarily conviction in a currency call, because how do you have conviction in how this is going to play out?
The weather.
I want you to watch.
Is that Bloomberg surveillance without the vowels?
It is. You know, just we hired a marketing
team. Did we ever
team.
get an explanation from Aberdeen on that? Why did
team.
Aberdeen do that?
What's that gif about, like, hey kids, how's it going?
Chart banners in the control room going, Tom misspelled it. No, it was our consultants.
Our marketing consultant said drop the vowels. Drop the vowels for Gen Z. It's kind of insulting to Gen Z, isn't it?
Just
drop the vowels from everything. It's great marketing. Great marketing. Futures are positive from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian has now turned into a powerful Category 3 storm as it takes aim at Florida. Ian made landfall in Cuba early today, and it's now on track to become the worst storm to hit Tampa in more than a century. Hurricane conditions could arrive in Florida Wednesday morning with winds of up to 140 miles an hour. Goldman Sachs has sharply lowered its oil price forecast. Still, the firm says it remains bullish because of a tight market. Goldman predicts Brent crude averaged $100 a barrel in the last 3 months of the year, and that's higher than today's price, but below its previous forecast of $125. Senate Democrats have proposed a short-term funding bill aimed at averting a government shutdown. Congress must pass a measure by midnight Friday, but the package includes a measure to speed up energy permits that's opposed by most Republicans and some Democrats. Leaders of both parties are anxious to avoid a shutdown in a little more than a month before midterm elections. 1,000 fast food workers at San Francisco International Airport have gone on strike for higher wages, and they're telling travelers to bring their own food so they don't have to cross a picket line. The head of the Unite Here Local 2 union says most of the workers have not gotten a raise in 3 years. The airport's not commenting. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
So the FOMC is committed to using its tools to bring inflation back down to our longer-run goal of 2%. Last week, we took another decisive action to remove monetary policy accommodation. We raised the Fed funds rate by 75 basis points. And we're continuing the process of reducing assets off of our balance sheet, which also reduces accommodation.
Someone I listened to carefully, Loretta Mester, without question, the mathematician of all of the Fed talent, the Cleveland Fed president, is just exquisite. I really, really listen to the dynamic she displays in her English prose. Lisa Abramowicz and Tom Keene. And what we're going to do here is a little different. We're not doing like the weather doom and gloom, although Lisa, come on. You in the big, like the boots and the yellow rain thing, standing in the surf of Florida. I think I can see it.
Are you trying to send me down to the hurricane in Florida? Sure, Tom.
We're going to do this a little different now. We do this with Brian K. Sullivan, who owns a high ground on weather and business for Bloomberg. He has been dedicated for years in following this. What gets my attention of Ian, Brian, is 45 miles an hour and suddenly 125, Category 3. Can this gain ever more momentum to Florida?
Yeah, exactly. Intensively rapidifying, and it's going across the very flat part of Cuba right now, and it's going to head into the Gulf of Mexico, get some warm water, build up even stronger, and I think in the next couple of hours we could see it crack Category 4.
One of the things, and Lisa mentioned this on the break here, is every single guest on Bloomberg Surveillance has bought something down in Florida. I mean, they're all on the coast. There are all these beautiful condos. Has there been any change over the years to the coastline real estate that is affected by these historic storms? They haven't moved back from the shoreline, have they?
No, they haven't. And in this case, that part of Florida doesn't always get hit. So there's been a lot of kind of whistling in the dark, and the idea that, it never happened to us before, so it's not going to happen now. I mean, you have to go back probably to 1921 to get a storm of this strength and this power coming into that.
Wait, you're serious? We have to go back to Humphrey Bogart and I think it was Lauren Bacall in that hurricane movie?
Yeah, Key West, right? Or
Key West. Are you kidding?
Yeah.
Wow.
Yeah, that's one big concern that people have as they watch the development of Hurricane Ian, especially hitting some of these areas that have been built up. And Brian, how much would the damage potentially be if they got a hurricane akin to what we saw in 1921, which some people think is the last analog?
So if it hits exactly right, you're talking $60 to $70 billion worth of damage throughout Tampa Bay.
Wow. So at this point, how do people kind of prepare for this? And longer term, what does it mean in terms of development, in terms with recognition of whether this is going to become a more frequent event? Is it?
Well, I think at this point, all you can do is get out of the way. I mean, it's too late. But in terms of the long term, this is a conversation the entire United States has to have about what we build right along the waterfront and how much money we put. We're seeing this in Boston, we're seeing this in Miami, we're seeing this in Norfolk, Virginia, all over.
Right. Brian, Tampa is just one example. A major shout out to Jeffrey Vinnick, ex-Fidelity, who did so much for Tampa along with others. A boom economy. There's going to be a compare and contrast with the heartbreak of San Juan. I mean, there's no question about it. What does Tampa have to do to not have some of the sadnesses that were observed in San Juan in recent weeks?
I think in some part, the infrastructure on the mainland is a little more robust than the infrastructure on Puerto Rico. So, at that point, you're dealing with the resources of the entire country, and they should be going to Puerto Rico as well. But I think it's mainly a question of infrastructure and how quick you can bounce back. So, the grid on the mainland is a little more robust. The transportation system on the mainland is a little more robust, and it's just easier to get materials into South Florida than it is to put them on a boat and send them to Puerto Rico.
Brian, can you give us a sense of the trajectory for the rest of this season, this hurricane season? Are there other forms brewing? Do you get the sense that this is going to be an exceptionally active one or just par for the course?
Well, the season forecast was for it to be above average, and it was very quiet through August, but now it's kind of picking up speed as we're heading to September here. The other interesting thing is the Western Pacific. Vietnam is going to get hit today by a very strong storm. Japan has been hit by a few very strong storms. So you're seeing that kind of two pockets starting to come into focus here.
Brian, thank you so much. Brian K. Sullivan with us on a storm that we've underplayed in the Northeast, but which is very serious. I don't make jokes about it, Lisa. There's some real hardship here. But for Brian to say we wander back to 1948 in Key Largo with Bogart, this is not funny. That movie caught the violence that's real.
Well, and it comes at a time when a lot of people have moved to Florida. Florida has seen a huge amount of inward migration. Enormous. It's now called Wall Street South. And you have these financial centers, and there were stories about it today about how they're all shutting down in preparation for the hurricane. How does weather deal with some of the immigration that they have seen and the buildup that you've rightly pointed out, Tom, especially on the shorelines? That's going to have to be an increasing question and pressure, although, to date, we haven't really had to deal with it, at least post-pandemic.
Yeah. David Kotak, who is always a good friend of the program, is living this in Florida. He emails in, "It is too late for Tampa to do anything for Ian except evacuation." They have, in the words of Mr. Kotak, writing cryptically, they've just simply avoided a lot of the efforts that were required after what we saw with the hurricane of the century here. I think it was in 1995. Lisa, let's go over the data. It's a better tone today as we go to Conviction Wednesday. Tomorrow, I'm looking at the real yield, 1.50%, a little better than the fear of yesterday.
Well, the fear, can we just talk about that fear? Just because I like to do that, but also because we're looking at a real yield on the 10-year Treasury that went up past 1.6%. This was a pain point. I was speaking with a number of strategists who were talking about how that would be kind of the breaking point for markets. Well, we got there, and markets didn't break. So what does that mean? Where is the threshold at a time where people have gotten used to zero real yields for so many years?
On the Bloomberg terminal, folks, you can do the math. You can see the data, and the data of 04, 05, 06 is some form of moving average of about 2.05%. Lisa, I don't hear people really modeling out 2.05%. Except Bill Dudley and a few others select.
Exactly. And I was speaking with Michael Schumacher at Wells Fargo, and he said to me, I raised the point of what about 3% real yields, like what we used to see? And he said, that scares me. No, that's impossible. 1.5% is it. And he's not alone. Most people agree with him.
Okay, I'm going to get up from the surveillance nap with Vet Bill and Kennel Fee, and we're going to observe the auction. What am I looking forward to this afternoon, Lisa?
How much demand there is. Is it a successful, orderly auction? Are people excited about the yield that they're getting, which is the highest going back more than a decade?
It's just like poetry, folks. I mean, never have I heard such an interesting, nuanced discussion. Maybe I'll sleep through it, Lisa. That would be just as well.
Well,
Futures up 46. Dow futures up 279. The VIX 30.95. Stay with us. This is Bloomberg.